Hello and welcome to this chapter ratio analysis. So first we will understand all the formula, some theory part also will cover, and then we'll take some of the important questions of this chapter. So are you ready? Yes, sir. Okay, so come to the summary of ratios. First we will revise your ratios. All ratios will revise current ratio, current asset upon current liabilities. And this ratio is the ratio for checking the liquidity of the company. Standard ratio is 2:1, but according to the nature of the business, it can be high or it can be low. Next liquidity ratio is quick ratio. Quick ratio is quick asset upon current liabilities. And what is the meaning of quick asset? Quick asset is current asset minus inventories. This is a more stricter test of liquidity than current ratio. It does not consider inventory because it will take more time to realize inventory. The standard ratio is 1:1. Then the next ratio is cash ratio. This is even stricter than quick ratio. It only takes into account cash and bank and marketable securities divided by current liabilities. It is absolute liquidity of the business. That is, if all creditors come suddenly, then how much creditors you can pay, what portion of current liabilities you can pay from your cash, bank and marketable securities. Fourth ratio is defense, basic defense interval ratio. This ratio basically measures that for how many days you can meet your regular cash expenditure. And how do you compute it? Cash and bank balance plus net receivable plus marketable security divided by operating expense per day, daily operating expense, average daily operating expense. Net receivable means your debtors, bills receivable, even they can be realized and you can use the money for operating expense. In some books they don't consider receivable, they only consider cash and bank and marketable securities. But in the study material of the institute, they have also considered net receivable. Then what is net working capital? Current asset minus current liabilities. What is equity ratio? Equity ratio means shareholders equity divided by net asset. Shareholders equity means equity share capital plus reserve and surplus. And net asset means fixed asset plus current asset minus current liabilities. So basically what portion of your net asset is financed by shareholder. And then debt ratio. Debt ratio means total debt upon net asset. That is what portion of your net asset is financed by the outside parties other than shareholder. So if this ratio is high, it means risk is high. If equity ratio is high, it means risk is low. Now next is debt to equity ratio, very popularly called debt equity ratio. So total debt upon shareholders equity. Usually we take long term debt, but if the problem is specified, you can take long term plus short term also. Is it right? So this ratio, if it is high, risk is high. These ratios are also called capital structure ratios. Next is debt to total asset ratio. So total debt upon total asset. So total asset means fixed asset plus current asset. And net asset means fixed asset plus current asset minus current liabilities. Again, this ratio measures what portion of your total asset is financed by debt. If this ratio is high, risk is high. Then there is capital gearing ratio. Again, tick mark important. Capital gearing ratio means fixed charges bearing security. Fixed charges bearing securities, that is those securities on which you pay fixed charges like interest or preference dividend, fixed charges bearing securities, preference share capital, debenture plus other borrowed fund divided by, in the denominator it will be equity shareholder fund. Equity shareholder fund. How do you calculate equity shareholders fund? Equity shareholder fund is equity share capital plus reserve and surplus minus losses. So it measures the ratio of fixed charges bearing security to equity shareholder fund. Higher the ratio, higher the risk. Higher the ratio, higher the risk. If they ask you to comment, you can comment. And then we'll have proprietary ratio. Proprietary ratio means proprietary fund upon total asset. And proprietary fund means equity share capital plus reserve and surplus plus preference share capital minus losses and fictitious assets. That will give you proprietary fund. If this ratio is high, then risk is low. If this ratio is high, risk is low. It means more of your total assets are financed by the owners, and total asset will be fixed asset plus current asset. Fixed asset plus current asset is total asset. Now next is coverage ratio. Under coverage ratio we have debt service coverage ratio, that is how many times your earning is sufficient to pay interest and installment. That is earning available for debt service divided by interest plus installment. The standard ratio is 2. Higher the better. Higher the better. If this ratio is high, risk is low. If this ratio is high, risk is low. In case of coverage ratio, if the risk is high, if the ratio is high, risk is low. And then interest coverage ratio, EBIT upon interest. How many times your EBIT is sufficient to pay the interest? The ideal ratio is greater than 1. If this ratio is high, risk is low. Higher the better. If this ratio is high, interest coverage ratio is high, the company will be able to pay its interest easily. Next is, if they ask you to write a note on interest coverage ratio, you have to write all these points. Then another coverage ratio is called preference dividend coverage ratio, PAT upon preference dividend liability. Ideal ratio is greater than 1, higher the better. Higher the better. Higher the ratio, risk is lower. If ratio is high, risk is less. And then fixed charges coverage ratio, not very important but still note down, EBIT plus depreciation upon interest plus repayment of loan plus preference dividend also, because that is also fixed charge. So the ideal ratio is more than 1, higher the better. Higher the better. If the ratio is high, risk is low. In case of coverage ratio, if more profit is available, it is better. Okay. Now the next is total asset turnover ratio. These ratios are called activity ratio, efficiency ratio, performance ratio, turnover ratio. So the question in the exam can be, name 4 activity ratio, or they will give you a balance sheet and they will ask you to find out activity ratios. It shows the activity or efficiency in utilization of the asset. So total asset turnover ratio, sales or cost of goods sold upon average total assets. Wherever possible, we'll take average. Sale is for a period, so the denominator should also be average of the total asset utilized during this period. Higher the ratio, higher the capacity utilization. Lower the ratio, lower the capacity utilization. How many? What is the amount of sale generated per rupee of total asset? Okay, then similarly we have fixed asset turnover ratio, sales or cost of goods sold upon average fixed asset. If sale is available, use sales data. If sales data is not available, use cost of goods sold data. Higher the ratio, higher the capacity utilization, better the performance. Lower ratio means lower capacity utilization, poor performance. In case of turnover ratio, higher is better. Next is capital turnover ratio, sales or cost of goods sold upon average net asset or average capital employed or average capital employed. And what is included in capital employed? Will be shareholder fund plus long-term debt. Shareholder fund plus long-term debt. Or there is one more way you can reach that number, or you can take assets minus current liabilities. Asset side minus current liabilities will give you capital employed. Higher the better. Working capital turnover ratio, working cost sales or cost of goods sold upon working capital. Higher the ratio, higher the efficiency in utilization of working capital. Inventory turnover ratio, first priority will be given to cost of goods sold. If that is not available, then take sales, or if the institute asks you to take sales, then take sales. Divide by average inventory. Average inventory means opening stock plus closing stock by 2. Higher the ratio, higher is the efficiency. Debtors turnover ratio, credit sale, not total sale, credit sale. Divide by average account receivable. Account receivable will be bills receivable plus debtor. Higher the ratio, higher the efficiency. Then based on debtors turnover ratio, we have debtors velocity or called receivable velocity, also called debtor collection period, also called debtors collection period. So there are two ways you can compute it. One is average account receivable upon average daily credit sale. There is one more formula, 365 by debtors turnover ratio. You can mention this also. So if this data is available, use this data, otherwise use this data. Higher this ratio shows how many days are taken to collect the data. Lower collection period is better. Lower collection period is better. Here lower DCP is better, so that funds are blocked for lower number of days. And now we have payable turnover ratio. It means annual net credit purchase, underline credit purchase, don't take cash purchase, upon average accounts payable. Accounts payable will be bills payable plus creditor. Okay, it tells you how many days on an average you take to make payment to your creditors. Then payable velocity, also called creditors payment period, also called creditors payable payment period, creditors payment period, also called creditors payment period. Formula is average accounts payable upon average daily credit purchase. Write down one more formula, 365 divided by payable turnover ratio. 365 divided by payable turnover ratio. If you are given payable turnover ratio, then just take 365 divided by payable turnover ratio. So how many days do you take to make payment to the creditors? Okay. Then we will now see profitability ratio based on sales. GP ratio, gross profit upon sales. Net profit ratio, net profit upon sales. Operating profit ratio, operating profit upon sales. What is the difference between these two, net profit and operating profit ratio? In net profit, non-operating income and non-operating expenses are also considered. In operating profit ratio, only operating income item and operating expense item are considered to check the operating performance of the business. Then cost of goods sold to sales ratio, very easy, COGS upon sales into 100. And then operating expenses ratio, administration expense, selling expense, distribution expense upon sales. Then operating ratio is cost of goods sold plus operating expense upon sales. So if this operating ratio is known, you can compute operating profit ratio. So somewhere below you can also mention that operating profit ratio is equal to 100 minus operating ratio. Or suppose you have to find operating ratio, then you can say is equal to 100 minus operating profit ratio. 100 minus operating profit ratio. Financial expense ratio. Financial expense, like for example interest, preference dividend, they are called financial expenses. Divide by sales into 100. Next is profitability ratio, which are related to overall return on asset or overall return on investment. So very important, this return on investment. So return or profit upon investment. Higher the better. Overall, it tells you overall return on your investment. Then return on asset, net profit after tax upon average total asset. Now there are two versions of this. One is before tax version, EBIT upon average total asset. This is before tax version. And after tax version is EBIT into 1 minus T upon average total asset. So it tells you how much is your rate of return on your total asset that you have invested. Total asset will be tangible and intangible asset and current asset also. Return on capital employed on pre-tax basis. EBIT upon average capital employed. You write it average. And on post-tax basis, EBIT into 1 minus T upon average capital employed. Higher the ratio, higher the performance. This ratio is useful to check how much on an average return the company is earning on its long-term capital employed. And then return on equity. This ratio tells you what is the return earned by equity shareholder. So we will take PAT minus preference dividend upon equity shareholder fund. Higher the better. Now next ratio is profitability ratio required for analysis from owner's point of view. EPS. EPS formula is PAT minus preference dividend upon number of equity share outstanding, that is earning available to equity shareholder. This ratio is useful for comparison with other company, with the same company, for valuation purpose also, for checking the growth rate also. Next ratio is dividend per share. Dividend paid to equity shareholder divided by number of equity share. One more formula write down. You can calculate dividend per share by multiplying face value or paid up value into rate of dividend. Then the next ratio is dividend payout ratio, DPS upon EPS. What portion of earning is distributed to shareholder in the form of dividend? Who are interested in this ratio? Shareholders, investors are interested in these ratios. Next is profitability ratio related to market or valuation or investor. So here one of the very popular ratios is price earning ratio. Market price per share upon earning per share. That is how many times is market price compared to earning per share. This ratio is you can use P ratio into EPS to calculate the market price of the share. Is it right? So this ratio is useful for computing market value of the share, P ratio into EPS. Then next is dividend yield. Dividend yield means DPS upon MPS. That is what is your return from dividend by comparing with the market value of the share. Okay. Then in the same way we have earning yield. Earning per share upon market price per share, or you can also write 1 by price earning ratio. Earning yield is reciprocal of P ratio. That is how much is your earning as a percentage of market price. Okay. How much is your earning as a percentage of market price? Then there is a book value multiple, a formula called book value multiple. Book value multiple is the ratio of market value upon book value per share, and book value per share is equal to net worth divided by number of shares. So what is the ratio of market price to book value? Book value is taken from balance sheet. These ratios are useful for comparison purpose and for valuation purpose. So the advanced version of this ratio is Q ratio, given by Mr. Tobin, one economist called Tobin. He says instead of taking book value, take the replacement cost of the asset. So the formula is market value of the company divided by assets replacement cost. That is how much will it cost to replace the asset. Is it right? How much will it cost to replace the asset? This ratio is not very popular in the exam or in general also. Just part of your syllabus. Okay. Now the next paragraph we will discuss is users and objective of financial analysis. Who are the users and what is their objective? Who are the people who are interested in the financial statement analysis of a company? So first general question is who are the parties who are interested in the financial statement analysis? Then second question they will ask you why they are interested. And third question is which ratios they will use for analysis purpose. Now different parties may use different ratios for their requirement. Like for example, a shareholder will use a different set of ratio. A creditor may use a different set of ratio, or a bank may use a different set of ratios. So who is the first party who is interested in ratio analysis? Shareholder. Why shareholder is interested? He is the owner of the company. His funds are invested. He wants to know whether this company will remain profitable or not. He wants to know whether this company will grow in future or not, whether his funds are safe or not, whether he should remain invested or not, or whether he should sell his share in that company or not. Is it right? He wants to know how much risk he is taking. So therefore, question would be for 2 marks. Name 4 ratios in which shareholder of a company would be interested. So shareholder of the company would be interested mostly in the profitability ratios. Why? Because his money is invested. Why do we invest in a company? To earn return, to earn profit. So therefore he would be interested in ratios like earning per share, dividend per share, price earning ratio, dividend payout ratio, and you add one more, return on equity. He will be interested in return on equity also. Return on capital employed. Is it right? Debt equity ratio. Who is the next user? The next user is investor. That is current investor and potential investor. Those who want to invest in the company. So those who want to invest in the company or who have already invested in the company, they are interested in knowing the overall financial health of the company. They will see what is the return of the company, what is the liquidity of the company, what is the risk in the company. So for that, they will be calculating many ratios, like they will be calculating profitability ratios. We have already seen profitability ratios, net profit ratio, operating profit ratio, return on investment ratio. Then you will be interested in capital structure ratios like debt equity ratio, proprietary fund ratio, total debt to asset ratio, capital gearing ratio. Then he will be interested in solvency ratio like current ratio, liquid ratio, cash to current liability ratio, and he also wants to know the efficiency of the company. So he will be calculating the turnover ratios also, asset turnover ratio, fixed asset turnover ratio, debtors turnover ratio, stock turnover ratio, working capital turnover ratio. Third party who is interested in a company's performance and liquidity position or financial position is lender. Why would a lender be interested in ratio analysis? Because the lender wants to check whether his funds are safe or not, whether he will get repayment or not, whether the company will be able to pay the interest and the principal in time or not. So which ratio a lender would be interested in? Coverage ratio. Name two coverage ratio in which lender would be interested. Debt service coverage ratio, interest coverage ratio. Then he will be interested in solvency ratio also, like current ratio, liquid ratio, because he wants to know company should have sufficient liquidity to pay his dues on time. Then turnover ratio, because he would be investing or lending to a company which is efficient. So company should have high asset turnover ratio, debtors turnover ratio, inventory turnover ratio, and he is also interested in profitability ratio. Because if the profitability ratios are good, the company can pay the interest and installment on time. So there is a bright chance that they will get their interest on time, installment of loan on time, principal on time. Just like lender, we have creditor. Why would creditor be interested? So same reason, creditor would be interested in knowing the financial position of the company, whether the company can pay their dues on time or not. Which ratio creditor would be interested in? Liquidity ratio. Example of liquidity ratio, current ratio, quick ratio. Okay, cash to current liability ratio. Then short term solvency ratios, liquidity ratio, same thing. Next party interested is employees. Why would employees be interested? Because the employee will also like to work in a company which has a high profit, growth potential, regular payments. Okay, they are in a position to pay the salary on time or not. So therefore employees are also indirectly interested. What are the ratios they would be looking at? One is liquidity ratio, because the company should be able to pay their salary, bonus and other staff welfare expenses on time. Second, they would be interested in long-term solvency ratio, because they want to work in a company where company will also survive for a longer period. So they would be checking which ratio? Debt equity ratio, total debt to total asset ratio. Then they also want to know the profitability of the company. So profitability ratio and return on investment. So in the exam they will ask you, name 4 ratios in which employee would be interested in. So this way you have to write the answer. Another party who is very interested in your performance is the government and the regulator, because accordingly the government will decide their fiscal policy, monetary policy, subsidy policy, tax policy, incentive to the entity, etc. Okay, tax policies are determined based on that. Subsidies are determined based on that. Interest subsidy are given based on that. Grants are given based on that. So they are interested in many ratios like profitability ratios. So you have to write in the exam which are the profitability ratios also. One of the most important stakeholders in the company is the management of the company, because they are running the show. So management is also interested in ratio analysis. Under management also we have different divisions, different departments like production manager. So production manager, they are interested in knowing data about output, production, okay. Which ratio they may be interested? Input output ratio, raw material consumption ratio. Then there are sales manager who are interested in ensuring that company has high sales are growing. So they would be interested in ratios like turnover ratio, like receivable turnover ratio. Then they are interested in several expenses ratio, like advertisement to sales ratio, selling and distribution expense to sales ratio, how much amount the company is spending on sales promotion. Then financial managers like you are interested in several ratios to check the financial health of the company. So they would be interested in almost all the ratios that we have learned, especially profitability ratio, return on investment, turnover ratio, capital structure ratio, because accordingly they have to take the correct measures also. Is it right? It is the financial manager on whose broad shoulders the company's finances are dependent. So they analyze various ratios to take corrective actions if it is not up to the mark. And then don't forget, a company has got a CEO or a general manager. The performance of a company to a large extent depends on the efficiency of the CEO. It is like a report card of the CEO. So therefore CEO also is interested in all ratios, because he is responsible for sales, he is responsible for production, human resource, inventory, marketing, everything. Next point is different industries. Now I will tell you one interesting thing. In different industries there are different ratios used for understanding the performance or comparison or understanding the growth. For example, if you are a telecom company, then many ratios are related to their calls and subscribers. For example, they calculate how much is revenue per subscriber. How much revenue per subscriber? That is called ARPU, ARPU, average revenue per user. Telecom company. So Bharti Airtel says we have 200 rupees ARPU. Jio says we have 220. Oh, Idea Vodafone says we have 30 rupees only, because now customers are running away. So that shows which company is doing good. Okay. Then in case of banks, they would be calculating ratios like loan to deposit ratio, operating expenses and income ratio. If you are a hotel, then you calculate room occupancy ratio. So if you have 100 rooms but only 60% are occupied, that is called room occupancy ratio. Airline companies, they see how many seats are used. Is it right? Bed occupancy ratio. If you are a transport company, you calculate ratios like passenger kilometer, operating cost per passenger kilometer. So the list is not exhaustive. Different industry may have some more ratios for evaluating their performance. Like as I have told you, in case of telecom company, ARPU. Which ratio? telecom company uses? ARPU, average revenue per user. Average revenue per user. Like that. This was just an example. They are not going to ask you. Next is application of ratio analysis in decision making. Tick mark important. The question they ask is here, why ratio analysis is important? Why ratio analysis is important? A theory question. So ratio analysis is very important in business, very useful for several stakeholders like as we have seen shareholder, investor, management. Balance sheet, P&L account, cash flow statement may not tell you the performance clearly or liquidity position clearly. So we use the balance sheet, P&L account and we do ratio analysis so that we can understand the profitability, the financial position, the liquidity, the risk, the growth of a company, right? So first benefit of ratio analysis is it helps us to understand the liquidity position, whether the company has sufficient liquidity to pay its short-term obligation or not. Is it right? And for that they measure ratios like current ratio, quick ratio, cash to total current liability ratio. Second advantage of ratio analysis, they will help us to understand the long-term solvency of a company, whether a company will be able to sustain in the long run or not. Because as an investor, as a lender, as an employee, we want to be sure that this company would be able to sustain in the long run. So therefore we compute ratios like debt equity ratio, proprietary ratio, total debt to total asset ratio, capital gearing ratio, profitability ratios. Okay, and that helps us to evaluate the long-term solvency position. Which is the next benefit of, what is the next benefit of ratio analysis? Very important, operating efficiency. If you look at the P&L account, you will only get figures of sale, expense, which will be in lakhs and crores. You don't really understand the efficiency. But if you do ratio analysis, you'll be able to see whether company is efficient or not. You can compute their net profit ratio, gross profit ratio, operating profit ratio, sales expenses to sales ratio, turnover ratios, and you will be able to check the operating efficiency. Then we have operating profitability, overall profitability. Why are you investing in a company as a shareholder or as an investor? You are investing because you are interested in earning profit. So does ratio analysis help you to understand the profitability? Yes. Name at least 2-3 ratios which help you to understand the overall profitability. Return on investment, return on equity, return on capital employed, return on total asset, ROTA, return on net asset, RONA, ROTA, RONA, ROE, ROE, okay, ROCE. And these are useful for not only management but also for other stakeholders like shareholder, investor, creditor, lenders. One of the major benefits of ratio analysis is inter-firm comparison. If you have to invest in say Infosys, the other comparable company is TCS or Wipro. Okay, then what you will do, you will take the ratios of all the 3 companies, because ultimately you will think that my risk is going to be the same. Then why not to invest in a company which gives me a higher return, which has got better potential, etc. So one can compare 2 or more companies and understand which company has been performing better. So this is very useful for investors. Another advantage of ratio analysis is You can use ratio analysis for budgeting purpose also. Based on your trend, you can prepare next year budget. You can prepare next year sales budget. You can prepare purchase budget. Okay. One of the chapters that you learn in cost accounting subject is budgeting. But the base of that budgeting is ratios also. If your cost of goods sold is 60% of sale, so if you know the sales, you know cost of goods sold. From cost of goods sold, you can also estimate how much purchases do you need. So if the sales department gives you sales estimate, using the GP ratio or cost of goods sold to sales ratio, we can estimate the purchases. This was just an example. So companies prepare their next year budget based on the ratios observed in the current year. That is the benefit of ratio analysis. Now the question is, what are the limitations of financial ratios? Limitation means certain drawback. There are some drawbacks or some challenges in using ratio as it is. Okay. So first challenge of using ratio is, if the company is into diversified product line means a company is into multiple businesses. Diversified means multiple businesses. Let's say for example ITC company. If you take total sales and total gross profit, it will not give you a correct picture, because that gross profit will include gross profit of tobacco business, hotel business, paper business, agri business, FMCG business. So then what we should do in such diversified product line companies, instead of calculating ratio for the entire company, we should compute the ratio for the business segments. Is it right? Different businesses in which they are invested or involved, and compute ratio business wise. That will help us to get the picture better. Another problem with ratio analysis is that when we are comparing different years performance, it is not directly comparable because of inflation. Inflation means high prices. So same raw material price must have gone up. Same inventory price must have gone up. So current year and previous year may not be comparable. If the inflation is high, then we will not be able to make correct comparison across different timelines. One more challenge with ratio analysis is seasonal factors. What is seasonal factor? That means in some businesses you have more sales in certain time period and less sale in other time period. So if you are comparing on quarter to quarter basis, quarter 1, quarter 2, quarter 3, quarter 4, these are the 4 quarters in a year. Is it right? So some quarter like 3 may have high revenue, high inventory, because demand for that product may be more, and in some quarter the demand may be less, sales may be less, inventory may be less. So if you are trying to compare, suppose it's a woolen garment, easy to understand example. You will have better ratios in third quarter. Third quarter in India is October, November, December. First quarter is April, May, June. Now woolen garment will sell more in November, December. So that time the ratio would be high. Better ratios. Whereas in some months the ratios will be very poor. So when you are dealing with a company which is into seasonal operation business, one has to take the seasonal factors in mind. Otherwise, you can make a wrong interpretation. You can make a wrong conclusion. Okay, suppose a company sells air conditioners. So which month So second quarter or first quarter will have more sales. First quarter, April, May, June, buying sales, high inventory, more profit. Then what happens in the third quarter? November, December, October. People don't buy much, sales go down, inventory level goes down. There can be losses also because fixed overheads will be there. So as a result of that, we have to be careful when we are using companies which are into seasonal business. Then year end adjustment. Another problem is what? Companies, in order to do makeup of the balance sheet, what is called window dressing. What is window dressing? Makeup. Okay, you look more beautiful than you really are because of makeup. Make up. You try to improve artificially. That is why it is called make up. Okay. So companies also do makeup of their balance sheet and P&L account by year-end adjustment. What do you mean by year-end adjustment? See, balance sheet is a point figure. The balance sheet which is on 31st March is used by the analyst. So 5 days, 10 days before, if they have suppose a current ratio which was less than 1, then they will improve the current ratio by borrowing money. If they borrow money, bank account debit to loan account, bank balance will increase. If bank balance will increase, current ratio will increase. Yes, if I have got surplus money, my bank manager also calls on 31st March or 1 or 2 days before and he says, sir, please put some money in the account so that we'll have better ratios. Happens. Is it right? In order to increase sales, what they do, in the month of March, they will book lot of sales invoices. And sometimes they pass entry for sales return in the month of April. So first you book sale. So ratios which are related to sales, those turnover ratios will go up. And next year you do the sales return entry. If you want to reduce debt equity ratio, then towards the end you repay the debt. Again next year beginning you borrow. Even sometime my bankers call me and say, sir, you deposit money right now, but withdraw it on 2nd of April. At least my ratios will be very good. That is called year-end adjustment. Year-end adjustment or window dressing. They try to give better picture of the balance sheet than what it was throughout the year. So throughout the year current ratio may be less than 1, but year-end adjustment will make it more than 1. Throughout the year debt equity ratio may be 3:1, but year-end adjustment may make it 1:1 or 2:1. Okay, turnover ratio may be 2:1, year-end adjustment may make it 2.5:1. One more challenge with the ratio analysis is that if different companies are following different accounting policies, their profitability will not be comparable. Financial statement will not be comparable. One company may follow straight line method, one may follow WDV method. So their fixed asset figure can change. One company may follow FIFO method for inventory valuation, one may follow weighted average. Stock may not be comparable. Depreciation policies are different. Amortization policies for intangible assets are different. So because of that, making comparison of two entities with different accounting policies will be different. Even the same firm, if it is using different accounting policies in different year, for same firm also, the comparison is difficult. So that is why we have an accounting standard in India, AS1, disclosure of accounting policies. Why that standard is there? Because of this point number 5. If companies are using different accounting policies, the investor will take care of the fact that they are using different accounting policies and then he will make the comparison. And point number 6 is there is no standard set of ratios against which a firm's ratios can be compared. Ratio analysis is not a rocket science where everything has to be perfect. It varies from company to company, business to business, time to time, size of the organization. Okay. So if you are a banking company, your debt equity ratio will be high because your business is to borrow money and lend money. But if you are a software company, debt equity ratio will not be high. Today in the morning I was looking at debt equity ratio of Reliance. It was something like 0.3, 0.4. But when I looked at the debt equity ratio of TCS, it was 0. And in some case it was 5. So it varies. Similarly, current ratio can vary. If you are a manufacturing company like a steel company, cement company, you have to carry lot of raw material because raw materials are not easily and quickly available. So they carry lot of raw material. Then they have work in progress. Factory sizes are huge. Lot of finished goods they have to keep. Debtors are also there because they are in a competitive business. So they have to give credit to all their customers, to most of the customers. But if you are a service company, let us say you are a Infosys software company, you don't need raw material. You don't need work in progress, finished goods like that. And because of the business, they usually take advance from the customer. They take a major portion of the work that has to be done in the form of advance from the customer. So that is why they may not have a high current ratio. So there is no standard set of ratios to come to a conclusion. So one has to see what kind of industry is that, what kind of business is that, what is the size of the business, and then you can form a conclusion. And the same point is repeated here. Difficult to generalize whether a particular ratio is good or bad. Is current ratio 3:1 good or bad? 3:1. For some company 3:1 is good. But for some company it may be bad because you are carrying excess liquidity. You are carrying excess liquidity. You are keeping inventory, debtor, cash in hand, prepaid expense, bills receivable, which do not generate any profit. They are idle funds basically. So therefore it can be good for one party but bad for another entity. Debt equity ratio can be good if it is 6:1 for a banking company, NBFC, non-banking finance company, debt equity, but bad for a service company. Okay. One has to look at the industry. Current asset 3:1 ratio. Okay, one student is asking a question. Yes. It's a good ratio. Yeah. We need to go inside the current asset. What are the composition of current asset? Then what is the business you are doing? Then you have to conclude. So without understanding the business model and the industry and the composition of those current assets and current liabilities, it may not be so quickly easy to say that this is good or bad. But as a student, we have to just understand the basics part. And the next point is financial ratios are not interrelated, not independent. Very interesting point. If you just look at one or two ratios, you may come to a wrong conclusion. One is to read multiple ratios. Look at profitability ratio, look at liquidity ratio, look at the capital structure ratios, and then you should form an opinion about a company. So when you go to a bank for taking a loan, the bank does multivariate analysis before they give you the loan. What do you mean by multivariate analysis? It means they will calculate several ratios. They will calculate several ratios. Then they will come to a conclusion whether this customer is to be given loan or not. So what banks do, they will calculate many ratios. then they will give them weightage, give them weight. For example, they have a matrix. If the ratio is between this and this, I will give so much weight. Then they calculate the total. It's like mark sheet. Like in current ratio, they will say if it is between 0 to 1, I'll give a mark of 0.5. If it is between 1 and 2, 0.7. More than 2, 0.9, something like that. So for every ratio, they have a marking system. Take the total of those marks. It's like in every subject you have a marking system. And after that, if the total exceeds a certain mark, then they take decision to give loan or not. So one ratio may be bad, but some ratios may be good also. So debt equity ratio may be bad, but your return on investment can be very high. Is it right? So therefore ratios are not independent. Ratios are interdependent. They depend on each other. So one should not come to a conclusion by looking at few ratios only. One has to read many ratios before we come to a conclusion. Now we'll take one more paragraph for discussion. Financial analysis is done in two ways. One is called horizontal analysis and one is called vertical analysis. So what do you mean by horizontal analysis? Suppose year 2022 is given, 2023. So that is horizontal. Is it right? Then you are given current ratio. This was 1.5, 1.8. So we will say current ratio has improved. So when we are comparing one year with another year, this is called horizontal analysis. Okay. Comparing different years ratios. Comparing different years ratios is called horizontal analysis. Then vertical analysis means suppose we are in year 2023, gross profit is 100, sales is 500, GP ratio 100 by 500, 20%. So when we take the same year and take the data from the same year column, so can you see it is vertical and this was horizontal, year 1, 2, 3, 4. Whereas when you take the figures of same year and do the ratio analysis, then it is called vertical analysis. So vertical analysis means you can compare two firms in the 2023. So horizontal analysis will be useful for year-wise analysis. Vertical analysis is useful for comparing one firm with another firm in the same year. Okay, now we'll solve some important questions on ratio analysis. Is it right? Some important questions we will solve on ratio analysis. So please come to question number 14. Question is, Gig Limited has the following information relating to year ended 31st March 2020 and 31st March 2021. Gig Limited. Share capital, reserve and surplus, long-term loan, net profit ratio 8%, GP ratio 20%, long-term loan has been used to finance 40% of the fixed asset. This is the long-term loan. So long-term loan is used to finance 40% of the fixed asset, which means fixed asset is equal to, or fixed asset into 40% equal to long-term loan. Can I say that? 40% of the fixed asset is long-term loan. So long-term loan is 30 lakh. Divide by 40% if I do, so that will give me the amount of fixed asset. Can anybody guide me? So fixed asset is 75 lakh. There is no name to this ratio. It is the ratio between long-term loan to fixed asset. Is it right? So basically they have used the formula loan upon fixed asset is 40%. Loan upon fixed asset is 40%. There is no standard name for this ratio. Stock turnover with respect to cost of goods sold is 4. Debtors represents 90 days sale. Company holds cash equivalent to 1.5. This is 1.5 months. Not 11/2. It is 1.5 months. 1.5 months of cost of goods sold. Then ignore tax. Very good. When they say ignore tax, enjoy and assume 360 days in a year. Then they have given you the balance sheet. You have to fill in the blanks in the notebook. Prepare balance sheet on 31st March 2021. Is it right? So from the limited information, you have to find lot of missing data. Question number 14. So write down, but first you look at this balance sheet carefully. There is a hint here. Share capital has not changed. This is a new problem, new type. Mark important. Source is study material of the institute. Share capital no change. But if you look at the reserve and surplus, it was 20 lakh. Now it is 25 lakh. So why the reserve and surplus has gone up? Because of current year PAT. Because of current year PAT. So can you guess what is the PAT of the current year? PAT of the current year is 5 lakh. Suppose opening balance is 20 lakh, current year profit 5 lakh, so closing reserve will become 25 lakh. If PAT is 5 lakh, you can compute the sales figure because PAT is 5 lakh, net profit is 8%. So from PAT, you can calculate sales. From sales, you can calculate gross profit. From gross profit, you can calculate cost of goods sold. From cost of goods sold, you can calculate cash and stock. From sales, you can calculate debtors. Is it right? So once you get cash, stock, debtor, and you've already got the fixed asset from loan, you can get the asset side total. So creditor will become balancing figure. Can I say creditor will become balancing figure? Because from the information, you can find out all other figures. Creditor will become balancing figure. These three are already given to you. Is it right? So this is a good question. So first you write down this balance sheet in the notebook. Right. Balance sheet. Write in the notebook this format. Balance sheet as at 31st March 2021. Same copy. When the institute gives you format, use the same format. Question is from study material. Are you ready now? Share capital, write down. How much share capital is given? Reserve and surplus closing, write down 25 lakh. Long term loan, write down 30 lakh. Other figures we have to find. Other figures we have to find. This is a question of finding missing number from the given ratios. Ready? Now you write down below working notes. Working note 1, write down calculation of current year's profit. Calculation of current year profit. So write down current year profit is equal to closing reserve and surplus minus opening reserve and surplus minus opening reserve and surplus. So that is 25 lakh minus 20 lakh, because there is no other information given. So we will assume the entire 5 lakh is current year profit. They have not mentioned about any dividend paid, otherwise that will affect our answer. Okay. Assumption: no dividend has been paid. Assumption: no dividend has been paid. Now we will calculate working note 2, calculation of sales. Right hand side rupees. What is the net profit of this company for the year? 5 lakh. And in the question, what is net profit ratio? 8%. Therefore, sales will be A by B. 62 lakh 50,000. This is understandable format. Working note 3, calculation of cost of goods sold. Right hand side rupees. Point A, sales 62 lakh 50,000 less gross profit. What is gross profit ratio in the problem? 20% into 62.5 lakh, 12 lakh 50,000. Therefore, cost of goods sold A minus B. Presentation is important. Every line is understandable. And you have to divide your answer into small points. Psychological advantage. They will give more marks. They will think each point is 1 mark. Okay. Calculation of stock. So you have to write stock equal to cost of goods sold upon stock turnover ratio. Stock turnover ratio. Cost of goods sold 50 lakh. Stock turnover ratio 4. Therefore, the answer is 12,50,000. Is it right? Working note 5, write down. Calculation of debtors. What is the debtors collection period in the problem? Debtor collection period is 90 days of sale. Okay. And how much is sales figure? 62,50,000. Which means debtor will be equal to 90 divided by 360, because the problem says 360 days. For easy calculation only. Proportionate will take 1560 to 500. Working note 6, write down. Cash in hand is equal to 1.5 months divided by 12 months into COGS as per the note given in the question. As per the note given in the question. 1.5 divided by 12 into 50 lakh. Come on. 6,25,000. Last working note 7. Calculation of fixed asset. This will complete asset side. Write down long term loan is rupees 30 lakh. 40% of fixed asset is 30 lakh. Therefore, fixed asset is 30 lakh divided by 40% is how much? 75 lakh. Up to this, write down properly. Any query you are welcome to ask. Anybody, any query? Yes. If you practice such questions, you will be able to handle the exam. Otherwise, it may not have come to your mind that the difference between closing reserve and opening reserve can be net profit. And that is your starting point. Without that, you can't get the stock, debtor and cash in hand figure. 4 marks or 8 marks, somewhere between 4 to 8 marks. So come back to your balance sheet. Fixed asset, just now you got some amount. How much was that? Fixed asset 75 lakh. Debtor, how much we had got? Debtor 1562 500. Closing stock, how much you had got? 12,50,000. Cash in hand, how much you had got? 6,25,000. So you please tell me the total of the asset side first. Asset side minus other items of liability side will give you sundry creditor. Sundry creditor will be balancing figure 1437. And what is the total of the balance sheet? 1 crore 9,37,500. 1 crore 9,37,500. This way you will write the total and then close the answer. Have you done? Please complete it. Once you complete, let me know. We'll go to next question 15. Question number 15. This question is was asked in October 18 MTP for 5 marks. Write down important. Similar questions have been asked in past exams. And what is new about this question? You will get bills receivable and bills payable also in the problem. Okay. Debtor velocity is 3 months. What is debtor velocity? Debtor's collection period. Very good. 3 months means 3 by 12 of credit sales. Okay. So once you want to find debtor, 3 by 12 of credit sales. Same thing for creditor. 2 months. It means creditor's payment period. How many days or months on an average do we take to make payment to creditor? 2 months. So if you have to find creditor, 2 by 12 of credit purchases. 2 by 12 of credit purchases will give you creditor figure. Then stock turnover ratio is 1.5 times. Gross profit ratio 25%. Bills receivable, bills payable. So debtors will include bills receivable. Creditor will also include bills payable. So by applying the formula, if you get debtor figure, it includes bills payable also. Bills receivable and bills payable. GP, this is my starting point. Because only one figure is given. Sorry, gross profit is given. So from gross profit, we'll calculate sales. From sales, we'll get cost of goods sold. Then from sales, we'll get debtor. From COGS, we'll get stock. Using this two, we'll get purchase. From purchase, we'll calculate creditor. Is it right? So one has to understand which answer will lead to which place. And then fixed asset turnover ratio is 4. So from sale you can get fixed asset also. So what is the question? Sales. So sales will get from GP ratio. And cost of goods sold. From sales and GP will get cost of goods sold. Then sundry debtor. From sales and your debtor velocity, you will get debtors. From COGS and stock, you will get purchase. From purchase, you will get creditor and using creditor velocity. Closing stock will get using COGS and stock turnover ratio. You will get the stock. And then we have fixed asset from this ratio. There is a note, closing stock is more than the opening stock by 10,000 rupees. So you have to find out first average stock. From average stock we will get the closing stock, because opening stock and closing stock has a difference of 10,000. So you have to find out closing stock, right? So what will be my starting point in this question? Using gross profit and GP ratio, we can find out the sales. Once you get sales, then a lot of answers you can easily derive. So first you write down step 1, calculation of sales and cost of goods sold. Right hand side rupees, point A, gross profit. We can go by formula also. Presentation can change. GP ratio. How much is GP ratio? 25%. So therefore sales A by B, 4 lakh divided by 25%, 16 lakh. And point D, cost of goods sold C minus A, 12 lakh. And one more thing, write down E, stock turnover ratio is 1.5 times. So F, average stock, D by E. How much is average stock? Average stock is 8 lakh. So in the heading, write down calculation of sales, cost of goods sold and stock and average stock. You could have prepared 3 working notes also. Is it right? Choice is yours. Now from average stock and opening stock, we will calculate closing stock. So step number 2, calculation of closing stock. Average stock is opening stock plus closing stock divided by 2. Average stock is how much? 8 lakh. Opening stock, assume X. Closing stock will be X plus 10,000. Closing stock is 10,000 more. Divide by 2. Therefore, X equal to opening stock equal to 7,95,000. Therefore, closing stock 7,95,000 plus 10,000, 8,05,000. Is it right? Now we will find out step 3, calculation of purchases. Because to find creditor, I need purchases. Purchases equal to cost of goods sold plus closing stock minus opening stock. Is it right? Can I put these two in a bracket? Closing stock minus opening stock. COGS is how much? 12 lakh. Difference between closing stock minus opening stock is 10,000. You don't have to write both the figures. Save time. Or you can write 8,05,000 minus 7,95,000. But if you have understood, then just write 10,000. So how much it comes to? Purchases is 12,10,000. Why do I need purchase? To find creditor. Any query on step 3? No query? Okay. Step 4, calculation of creditors. creditor velocity is equal to how many months? 2 months. Debtor is 3 months. Creditor is 2 months. So it means creditor plus bills payable is equal to 2 by 12 into credit purchases. 2 by 12 into credit purchases. Assumed all purchases are credit. No need to write also. Now creditor figure we don't know, but bills payable we know. How much is bills payable? 10,000 is equal to 2 by 12 into credit purchases 12,10,000. Now after solving this equation on your calculator, you will tell me what is creditor equal to. 1,91,667. 191,667 is right. Any query on this? In the same way, we'll calculate debtors also. Step 5. Presentation is important. Everything you have to write. So what is given to you? Debtors velocity. How many months given? 3 months. It means debtor plus bills receivable represent 3 by 12 into credit sales. But if nothing is given, all sales are credit. How much is debtor missing? Bills receivable figure is there. 25,000. 3 by 12 into credit sale was how much? 16 lakh. Solve. Therefore debtors final figure 3,75,000. Last working note. So we have found sale, cost of goods sold, debtor, creditor and closing stock. What is pending? Calculation of fixed assets. For that they have given fixed asset turnover ratio 4 times. Fixed assets turnover ratio is 4, which means sales upon fixed asset is equal to sales is upon fixed asset equal to 4. So fixed assets equal to 4 lakh. Now this question is not clear whether fixed asset turnover ratio is based on sales or cost of goods sold. So I will write one more answer. Up to this we have written. If you look at the institute answer, they have taken cost of goods sold for this ratio. But we will solve by both, because your institute in the exam they can deduct marks. So when you are in doubt, both. Alternatively, COGS divided by fixed asset is 4. 12 lakh divided by fixed asset is equal to 4. Fixed asset equal to rupees 3 lakhs. Okay. This way you will solve this question. Good question for exam purpose. Now we'll come to question number 16. Question is from May 18 RTP. Okay. Following figures are available in the books of Tirupati Limited. Fixed asset turnover ratio 8 times means sales upon fixed asset. Capital turnover ratio 2 times means sales upon capital employed. Inventory turnover ratio, cost of goods sold upon average stock. Is it right? Receivable turnover ratio, credit sale upon average receivable. Payable turnover ratio, credit purchases upon average creditor. GP ratio, GP upon sale. GP during there is 8 lakh. So this is my starting point. Is it right? From GP you will get sales. From sales you will get cost of goods sold. And then fixed asset turnover ratio is given. So you can get fixed asset, you can get capital employed, you can get debtors. Then from COGS you can calculate stock. From COGS and stock you can get purchases. From purchases you can get creditor. There is no long-term loans or overdraft. So in balance sheet there is no long-term loan or overdraft. Reserve and surplus is 2 lakh. So once you get capital employed here, capital employed minus reserve and surplus will give you share capital. Is it right? Closing stock is more than opening stock by 20,000. So that I will require here for calculating purchases. Calculate various assets and liabilities and prepare a balance sheet of Tirupati Limited. This you can delete. And prepare balance sheet of Tirupati Limited. Is it right? This question has not given us whether this fixed asset turnover ratio, capital turnover ratio, whether they are based on sales or whether they are based on COGS. So that is a very challenging problem before the student. Is it right? So what we'll do, we'll first solve by sales figure. If it is not going to tally, then we are going to change by using cost of goods sold. Only after looking at the institute's answer, I got to know that they have used cost of goods sold figure instead of sales figure for fixed asset turnover ratio and capital turnover ratio. How will the student know in the exam? Is it right? So you have to take a chance to start. Little torture for the student. First working note 1, step 1 write down. You can first calculate the answer, then prepare balance sheet. Or first you can write balance sheet and then write working notes one by one. Both way you can present. Is it right? Calculation of sales, cost of goods sold and average stock. So in one table we will get 3 answers. First you write down gross profit. Question in front of you. How much is gross profit? Gross profit is 8 lakh. Very good. Amazing. And how much is GP ratio? GP ratio is 25%. So therefore, sales is equal to A by B. Is it 32 lakh? Yes. Point number D. Cost of goods sold C minus A. 24 lakh. Point number E. Stock turnover ratio. Any other presentation is also welcome. You will not lose mark, don't worry. So what is the inventory turnover ratio given in the question? Inventory turnover ratio 8 times. So point number F, you will get average stock. Average stock will be D upon E. D upon E. So that is 3 lakh. Now from average stock and the difference between opening and closing stock is 20,000. We will be able to find out the opening stock figure and closing stock figure both. Is it right? So step number 2. Calculation of closing stock. So this is another type of question they ask in the exam. Average stock is equal to opening stock plus closing stock divided by 2. Average stock is 3 lakh. Opening stock assume X. Closing stock assume X plus 20,000 divided by 2. So student will solve and give me the answer. What is X equal to? X equal to 2,90,000. And what is closing stock equal to? You will add 2,90,000 and 20,000 more. So that gives you 3,10,000. Then step 3 will find purchases. Calculation of purchases. Purchases equal to cost of goods sold plus closing stock minus opening stock. Can I write closing stock minus opening stock in one bracket so that you can just write 20,000 directly? Cost of goods sold previous table 24 lakh. Difference between closing stock and opening stock is 20,000. So this comes to 24 lakh 20,000. Is it right? So can I use this figure to find out the creditors now? For creditors, payable turnover is given. Payable turnover. So using payable turnover and purchases figure, we can find the creditor figure. So step number, how many steps you have done? This is 4. Calculation of creditor. Payable turnover ratio. Payable turnover ratio is equal to purchases upon creditor. So can I say creditor is equal to purchase divided by payable turnover ratio? How much is purchase we have computed just now? 24 lakh 20,000. And how much is payable turnover ratio in the problem? Payable turnover ratio is 6. So student will give me the answer. Round off the last digit. 4 lakh 3,000. 3. Is it right? Step 5. calculation of debtors. Debtors equal to sales upon receivable. I am not writing average receivable because average is not possible in this problem. Is it right? So what you're getting is average receivable, but that will be my final answer also. How much was sales you have computed? And how much is your receivable turnover? Receivable turnover ratio? Receivable turnover ratio is 4 times. 32 lakh divided by 4 times. So debtor would be 8 lakh. So up to step number 5 there was no problem. The problem is in step number 6 and 7. Step 6. Calculation of fixed assets. Fixed asset equal to sales upon fixed asset turnover ratio. Yes or no? Sales upon fixed asset turnover ratio. Sales is 32 lakh. Fixed asset turnover ratio 8. Answer 4 lakh. Step 7. Calculation of will calculate by COGS also. Okay. Alternatively, right here. Fixed asset equal to COGS upon fixed asset turnover ratio. We will see which answer will help us to tally the balance sheet, because balance sheet is also asked, so balance sheet should tally. Is it right? If only fixed asset was asked, then first is enough, because we use sales figure. How much is COGS? Divide by 8. Answer. Step 7. Calculation of capital employed. Capital employed equal to sales upon, come on, capital turnover ratio. Sale is how much? 32 lakh. Capital turnover ratio 2. 16 lakh. Right, alternatively. Capital employed equal to COGS divided by capital turnover ratio. How much is COGS? Divided by 2. Answer. One more working note. Step 8. Calculation of share capital. Share capital equal to capital employed minus reserve and surplus. Is it right? So here we'll have two answers. Alternative one answer will be share capital equal to, if I take 16 lakh and reserve and surplus is given in the problem, how much? 2 lakh. So then my answer will be 14 lakh. And if I use second alternative, that is if I use COGS, then my capital employed is 12 lakh minus 2 lakh is equal to 10 lakh. Is it right? Now wait, we will check on calculator whether COGS will help us to tally the balance sheet or sales will help us to tally the balance sheet. Okay. What are the items on the liability side? First you check. You have share capital, you have reserve and surplus, and you have creditor. So what is the total you are getting? If I take share capital, how much is share capital if I take on sales basis? 14 lakh. Reserve and surplus was 2 lakh. And creditor was how much? 4,03,333. On the asset side, fixed asset on sales basis was how much? Fixed asset was how much? When I use 1 minute, I'll check. 4 lakh. And if I use COGS as a basis, then it is 3 lakh. First you have to wait. I will check which answer is right. Okay, suppose you are stuck in the exam. You have to check which is right. And then what is my stock? Closing stock is 3,10,000. That will be same. Debtor will also be same. How much is debtor? Debtor will also not change. 8 lakh. Okay, debtor. So if I use sales figure, other current asset will be balancing figure. Other current asset will be balancing figure. So tell me how much is other current asset in sales column. Four lakh. And suppose I take cost of goods sold as a base, share capital was how much? 10 lakh. Then my other current asset will be this will be 16 lakh 3,330. 1,93,333. Write both the answers. Here there is a difference of 4 lakh. Here the difference is 1 lakh. So 4 minus 1, 3 lakh difference. So exactly the difference is 3 lakh here. So now you write down balance sheet. balance sheet, write down heading balance sheet. Heading, write down balance sheet. Then under balance sheet, write down two columns: sales basis, COGS basis. Sales basis, COGS basis. Sales basis and COGS basis. Now you can copy. Sales basis column, you will write share capital 14 lakh. COGS basis, COGS basis, you will write 10 lakh. Now the institute can't deduct marks, okay, because you've written everything. So even if they try to deduct marks, they will fail in their duty. Reserve and surplus will be same because this figure is given in question, 2 lakh, 2 lakh. Creditor figure will be same. It is based on purchase, 4 lakh 3,333. 4 lakh 3,333. Fixed asset figure will change. Fixed asset figure will change. It will be 4 lakh or 3 lakh. Remaining figure, stock and debtor, will not change. 3 lakh 10,000, 3 lakh 10,000. Debtor will be same, 8 lakh, 8 lakh. Other current asset is a balancing figure and therefore this will change. According to assumption, your answer can change. So instead of writing only on basis of one assumption, what I did, I solved by both the assumptions. If suppose other current asset figure was also given to you, and then if the balance sheet does not tally, then you have to take only that column in which balance sheet will tally. In one exam they had given that figure and the balance sheet was not tallying. Then the student was worried why it was not tallying, which means probably the fixed asset turnover ratio and capital turnover ratio was based on cost of goods. Little dangerous question. It is also not appropriate on the part of the institute to give a question like this without specifying whether the turnover ratios are based on sales or cost of goods sold. Usually these two ratios are based on sales. Now any query on this question number 16? 17 on your own. Come to question number 18. Question number 18. From the following table of financial ratio of R textiles, comment on the various ratios given at the end. Very good. This is a question of comment only. No need to calculate anything. The source of this question is May 2019 RTB. So even this kind of questions have been asked in the past exams for 4 marks. And these are good questions because it helps you to understand whether the student is conceptually clear or not. Because you should know what is happening. Current ratio was 2.2, 2.5, 2.5. Current ratio of last 2 years is given and industry average is given. So first you have to check whether as a company are my ratios improving or not, and then you have to see whether compared to the textile industry what is my status, how have I performed compared to last year, how I have performed compared to the industry. So you will quickly participate, only will discuss as a homework you will write in the notebook on your own. So current ratio has improved. Current ratio has improved in the current year, and it is also matching with the industry average. In the first year it was below industry average, but in the current year they are able to match the industry average. So liquidity position is good. Then quick ratio in the first year was as per industry average. Current year it is slightly better than the industry average, which means the liquidity position is good because it is more than the industry average. But one can also see that there should not be idle funds. Too much of liquidity means idle funds are involved. So because we don't have enough data, we don't know the kind of business they are doing, we really can't comment, but it is also possible they have idle funds. What about receivable turnover ratio? It is constant and it is as per the industry standard. So there is no problem with receivable turnover ratio. What about inventory turnover ratio? It was 9, it was 10, and industry is 6. So this company has got a higher inventory turnover ratio. Inventory turnover ratio is increasing and it is higher than the industry, indicating efficiency in the inventory management. Receivable turnover ratio has decreased by just 1 day and it is slightly above the industry average. So again, not a major source of concern. Industry is 85, we are 86. 1 day is not a very significant difference. Is it right? Now let us look at the profitability ratio. Return on investment is decreasing. For the entity, return on investment is decreasing, but still it is very high than the industry. So they should try to keep the return on investment high only, not let it fall. What about operating profit margin? It has been maintained and it is very higher than the industry. Compared to 10%, they have got 19%, which is very good. Their operating efficiency is very good compared to other players in the same industry. What about debt equity ratio or debt ratio, debt to total asset? It has decreased slightly, which is nice, and it is even lower than the industry average. So the risk of this entity is lower than the other players in the industry. So risk wise also it is lower. And what about return on equity? Return on equity has improved in the last year compared to previous year, and it is very high. So this company has performed better than its competitors, peers, and the industry. So if you have this kind of data, you can say yes, this company is good and we can invest in this company. So this way you have to comment on the liquidity position, operating profit, financing, and return to the shareholders cost of capital. Okay, you will be able to solve such question. Okay, now we'll come to question number 21. Question number 21. We'll take a small break and then we'll take question number 21 and more questions. Okay, welcome back to this wonderful chapter, ratio analysis again. So we are going to solve an important question now. Question number 21. Again a very different question. And the source of this question is May 2021 RTP. So in the exam we have seen questions from RTP, MTP and study material are getting repeated. and even the past exam questions are getting repeated. So from that angle, this is an important question. Given below are the estimates for the next year by Niti Limited, rupees in crore. So understand, question is very different from the previous problems. Fixed asset, current liabilities, current assets, sales and EBIT. So they will be required for ratio calculation. The company will issue equity fund of rupees 5 crore in the next year. And these estimates are also for next year. Can you see this next year? Next year. The company will issue 5 crore in the next year. It is also considering the debt alternative of 3.32 crore. So 5 crore they are going to raise from equity, 3.32 they are going to raise from debt. Total they want to raise 8.32 crore for financing the assets. For financing the assets, because they need funds. If you look at the fixed asset, take on your calculator, fixed asset 5.20, current liability, current asset you add, fixed asset 5.20 plus current asset 7.80. How much is that? Is it 13? Out of 13, 4.68 is financed from current liability. 4.68 will be financed out of current liabilities. So is it 8.32? So they need 8.32 more, and that is why they have decided to raise 8.32 from equity and debt. That is the hidden information. Oh. The company wants to adopt one of the following policies given below. So now there are three policy options in front of this company. What are the policy options? That means they can either go with conservative financial policy. Conservative financial policy means low use of debt, low debt. Low, no, not low debt. In this case, the debt will remain 3.32, but low short-term debt. In this example, it means low short-term debt, because short-term debt means you have to pay them immediately. So you don't want to keep too much of short-term debt, otherwise repayment obligation will come. So 1.08 they will take from short-term debt, 2.24 they will take from long-term debt, and the interest rates are different. So moderate policy 2 is short-term, 1.32 long-term. Aggressive policy 3 short-term, 0.32 long-term. So this is aggressive policy. Too much reliance on short-term debt. Assuming tax rate is 30%. So that will be required for tax calculation. Compute the following for each of the following financial policies. That means every calculation you have to do 3 times. One for conservative policy, one for moderate policy, one for aggressive policy. And what are the calculations you have to do? One is you have to do calculation on return on total asset. Return on total asset formula is EBIT into 1 minus T upon total asset. This will not be affected by how you have financed your debt. Am I right? Because it is EBIT. Up to EBIT calculation, we don't have to deduct the interest. Since we are not going to deduct the interest, our answer will not be different under conservative, aggressive or moderate policy. Okay. The question is not clear whether I have to compute before tax or after tax. But because tax rate is given, we will take it after tax only. Or if you want, you can solve it 2 times. One is pre-tax and one is post-tax. Second, you have to compute return on owner's equity. This answer will change because owner will get earning after paying interest. Owners will earn only after paying interest, and the interest amount is changing under the three policies. Interest amount will be changing under the three policies. So therefore, we'll have to open three columns for these three, and net working capital will also change. Why? Because your short-term debt amount is changing. If short-term debt will change, current liability will change. Oh, if current liability will change, then current ratio will also change. Net working capital will change. Is it right? So for first answer, I will only do the calculation once, but for the other three answers, I have to do the calculation separately under conservative, moderate and aggressive policies. Is it understandable? So write down one by one. Step 1. Step 1. Return on total assets. We'll do it two times to avoid any risk before tax and after tax. So before tax will be EBIT upon total assets. Total asset in bracket, that is fixed assets plus current asset. So how much is EBIT in the question? 2.30 crores. Divide by how much is fixed asset? 5.20 crore. How much is current asset? 7.8. Multiply by 100. Give me the final answer. Give me the final answer. 17.69%. Then write down below that return on total asset after tax. So that formula will be, now you can simplify it, return on total asset pre-tax into 1 minus tax rate. So that will save time. Once you have computed pre-tax, we can compute post-tax by just multiplying by 1 minus t. Tax rate is 30%. Tax rate is 30%. Final answer 12.38%. This will not be affected by the debt alternative. Note, this answer will not be affected by financial policy. This answer will not be affected by financial policy. Then we have to compute return on owner's equity. Will that answer get affected? Yes. Will that answer get affected? Yes. Write down answer 2. Yes, step 2 write down. Answer 2 or step 2. Calculation of return on owner's equity. So it will be PAT divided by shareholder fund. Is it right? PAT divided by shareholder fund. So to reach PAT, from EBIT, first deduct interest, then deduct tax, then you will get PAT. Right hand side rupees in crores. and we'll draw three policies. Which are the three policies we will write? Conservative policy, moderate policy, aggressive policy. Okay, then write down point number A, expected EBIT. They have given expected EBIT 2.30. 2.30. Point B, less interest. Now interest will change because they are using two types of debt. One is short term debt. Now see, in the conservative policy, short term debt is 12% of 1.08. 12% into 1.08. How much is that? 12% is rate, 1.08 is the amount of debt, amount. So you're getting 0.1296. Is it 0.1296? Next column, 12% into 2 crore. 12% into 2 crore. 0.24 lakhs. Next column, 12% into 3 crore. 0.36. Then small b, long term debt. Long term debt, you will take 16% of 2.24. Question in front of you. Come on. 16% of 2.24. 0.3584. 16% of 1.32. 16% of 1.32. 0.2112. 16% of 0.32. 0.0512. Is it right? So point number C will be EBT A minus B. So what you will have to do, take 2.30 minus and minus, both interest deduct both the interest, you will get EBT. So you get 1.812. Very good. Next. Come on. 1.8488. Very good. Come on, next. 1.8888. Point number D, write down earning after tax. Earning after tax will be EBT into 1 minus 0.30. That means EBT multiplied by 0.70. Is it right? No need to write tax. We don't want tax. I want earning after tax. So to save time and one line, you can do it. Take 70%. If tax is 30%, take 70%. You'll get earning after tax. Yes, come on. 1.2684. Very good. Take 70% of this. 1.29416. Very good. Come on, next. 1.32216. Point number E, write down owner's equity, which is in all the three columns 5 crore. Is it right? So point number F will be return on owner's equity D upon E into 100 multiply by 100 also. D means earning after tax. Take 1.2684 divide by 5 into 100. 25.37% we can do it. Write in 2 digits here. Okay, try the next one. Try the next one. Try the next one carefully. Take 1.29416 divided by 5 into 100. D by E. Come on. I am going to highlight it for you. You have to take these two numbers. 25.88% is right. 26.44% is right. Up to 2 digits enough. Any query on this? What is the next question? Net working capital. Is it right? So write down step number 3. Net working capital and current ratio. Next two question, net working capital and current ratio. Will the answer change? Yes, because current liability will change. So write down the heading, 3 columns, conservative, moderate, aggressive means use of more short-term debt. Okay. So first you will write down point A, current assets. Current asset is given in the problem. Can you see 7.80 right here, rupees in crores at the top right corner? So that is 7.8, 7.8, 7.8. Point number B, current liabilities. First write down here small a, current liabilities other than short-term debt. Other than short-term debt, which is given in the problem 4.68. Second line of the table. Question should be in front of you. And B, write down short-term debt. Go to the question. Check the short-term debt in conservative policy. How much is that? 1.08, 2.0, 3, 2.0, 3.0. So first you write here total B. Total B means total of current liabilities. Come on student. 5.76, very good. 6.68, come on. 7.68, point C. Net working capital. Net working capital A minus B. I am going to highlight, you are going to solve. This is current asset, this is current liability. Take calculator. 7.8 minus 5.76. 2.04. Very good. Next one. 1.12. Very good. Point. Very good. So you can see the current ratio is going to fall now. And last answer, current ratio. Current ratio will be A upon B. A upon B. Once again the highlighted ones. 7.8 divided by 5.76. 1.35. 7.8 divided by 1.12. Sorry, 7.8 divided by 6.68. These two number. Solve yourself. Next one. 7.8 divided by 7.68. 1.02. Okay, wait, the answer is not over. First you write down this much. In the institute answer they have made two table, but we can do in one table only by using proper strategy. Sometime in the exam we are running short of time, so why to waste time on drawing the same format one more time. Now come to your question last line. In your question last line it is written on the screen, also in your book also advise which financial policy should be adopted if the company wants high return. If the company wants high return. If the company wants high return, the answer is on the screen. Can you see aggressive policy gives you higher return on equity? On the screen last column. So if your objective is to earn high return, you will go with aggressive policy. You will use more short-term debt and less long-term debt. So write down, I will dictate, you will write down. If the company wants, write down, note or advice, write down, because they have asked you advice. Note or advice, if the company wants higher return, then it should adopt aggressive policy. Because in aggressive policy the return on equity is maximum. Because in aggressive policy the return on equity is maximum. In aggressive policy the return on equity is maximum. So they can ask you to comment also. Is it right? If they ask you to comment on current ratio, can you see what is happening in your current ratio? Is it increasing or decreasing? Current ratio is continuously decreasing because you are using more and more of short-term debt to finance your assets. Is it right? So it depends on the person's ability to take the risk. So they are willing to take a high risk for a high return. So now we'll come to question number 22. Following information has been gathered from the books of CRAM Limited for the year ended 31st March 2021. The equity share of which is trading in the market at rupees 28. The stock price is given 28 underline. Now they are giving you share capital 20 lakh. Face value is 20 rupees and total amount is 20 lakh rupees. So can you tell me number of shares? Number of shares is 1 lakh because that will be required here for EPS. Then 10% preference share capital is 4 lakh, reserve and surplus is 16 lakh, debenture 12 lakh profit before interest and tax. EBIT is given 8 lakh. Then tax rate is 25%. Can you see 25% here? First question is return on capital employed. Second question is earning per share. Third question is P ratio. And the source of this question is November 2021 RTP. Now, what is the meaning of capital employed here? Capital employed here means long-term funds employed. Long-term funds means capital employed means long-term capital employed. So we will add these four items: share capital, reserve, preference share, and long-term debt means debenture. And here return means EBIT. But they have not given us whether I need to compute pre-tax or post-tax. So I will solve by both. Is it right? Then earning per share is very easy. From PBIT I will deduct interest, tax and preference dividend. I will get earning after tax. Divide by number of shares. Yes, come on. Return on capital employed means the capital which is used for doing business, which means long-term capital employed. Borrowed capital is also considered. And once you get EPS, you can find P ratio. Formula for P ratio. Come on, P ratio. MPS upon EPS. Where is MPS? First line of the question. 28. And EPS will get from your calculation. Is it right? Why are you waiting? Why don't you solve? So write down first step 1. Return on capital employed, bracket pre-tax, okay. Then write down ROC is equal to EBIT upon long-term capital employed. EBIT upon long-term capital employed, that is, I will write in detail, share capital plus reserve and surplus plus debenture. Share capital will include both equity and preference, okay? Or you want to write equity share capital separately, preference share capital separately, you can do that also. So now EBIT is given ready-made in the problem. How much? 8 lakh. And to earn that 8 lakh, what was the capital employed? So first four items you have to add. 20 lakh. But you have to present it. Plus 4 lakh. 52 lakh figure is not appearing in the question. So the student will have to put effort. No shortcut. Otherwise institute will apply shortcut on you. And then multiply by 100. So the answer is 15.38% approximately. And you write one more line. ROCE post-tax. In some answer they are solving by pre-tax, in some answer they are solving by post-tax. Will give both. So the answer will be ROCE bracket pre-tax into 1 minus tax rate. Keep writing also, because this they have not written in the answer. In the institute's answer, this post-tax, okay, they have given, I think, yeah, both they have given. In one exam they had not given. And what is the tax rate they are given? 25%. So 1 minus 0.25. 11.54% approximately. When you are rounding off the second digit, write approximately. Any query on this? What is step 2? Earning per share. Very easy. So write down step 2. Earning per share and market price per share and P ratio, and P ratio. Both will get in the same table. Yes, we have less time in the exam. If you have less time, 1 working, more time, 3 working, 4 working. Okay. So first we will write EBIT. How much is EBIT? 8 lakh. Check whether we have to pay interest. Less interest. If you see the question, you have 12% debenture. 12.5. Is it 12.5 or 12? Okay, 12.5%. And what is the amount of debenture? What is the amount of debenture? 12 lakh. Very good. So 1,50,000. So what we'll get is called EBT. A minus B. 6,50,000. Preference dividend will be deducted after earning after tax. EAT. EAT will be EBT into 1 minus 0.25. It means you take EBT 6,50,000 into 75%. 25% goes in tax payment. 25% goes in tax payment. First you type 6,50,000 into 0.75. 487,500. Okay, point E write down. Now if you have preference dividend also, you will deduct that also. Less preference dividend. Calculation must be shown. What is the rate of dividend? 10%. What is the face value of preference share? Total 4 lakh. Is it 4 lakh? So you will get 40,000 here. Am I right? So point number F is called earnings available to equity shareholders. Earnings available to equity shareholder D minus E. Little fast now. 447,500. Okay. So point number G would be number of equity shares. Number of equity shares are 20 lakh divided by 20 rupees face value, which comes to 1 lakh. Then write down EPS. F divided by G. 4.475. Is it 4.475? Point number I write down MPS. Bracket given. Is it 28? Is it 28? Point number J, P ratio, price earning ratio, I upon H, 28 upon 4.475. So 6.2 times approximately. Is it 6.26 times approximately? Any query on this wonderful question? No query? So that is another important question for 4 to 6 marks, maybe 8 marks. Question number 23 now. This question is from May 2022 RTP. Oh. FM Limited is in a competitive market where every company offers credit. Wow. To maintain the competition, FM Limited sold all its goods on credit and simultaneously received the goods on credit. The company provides the following information relating to the current financial year. Debtor velocity 3 months, creditor velocity 2 months, stock turnover ratio on cost of goods sold 1.5 times, fixed asset turnover ratio 4, gross profit ratio 25%, bills receivable, bills payable, then gross profit, and FM Limited has the tendency to maintain extra stock of 30,000 at the end of the period than that at the beginning. So closing stock is more than opening stock by 30,000. Determine sale and cost of goods sold, sundry, debtor, closing stock, sundry, creditor, fixed asset. So this is same as question number 15. Write down homework. Just go to question number 15. Same question, not similar, same. Only figures are different. What they have done in this question, they have multiplied all these figures by 3. This is the institute way of changing the question in the exam. So will you be able to solve 23? We have already done it. It was October 18 MTP 5 marks. Then they repeated this question in May 22 RTB. So from MTP it has moved to RTP. Now from RTP it will move to question paper. You are right, once in a while. Question number 24. This question is from March 21 MTP for 5 marks. Likely question for exam also. So the question is, SN Limited has furnished the following ratio and information relating to year ended 31st March 2021. Share capital, working capital. Working capital means current assets minus current liabilities. Gross margin 25%, inventory turnover ratio 5 times, average collection period 1.5 months, current ratio, quick ratio, reserve and surplus to cash and bank 3 times. Further, the assets of the company consist of fixed asset and current asset, while its current liabilities consist of bank, credit and other in the ratio of 3:1. Assume 360 days a year. Okay. You are required to prepare the balance sheet on 31st March 2021. So will you be able to solve? Write down, we will solve together. Together we can achieve great things. Okay. What will be my starting point? Current ratio is given. Working capital is given. So current ratio and working capital will help you to find out current asset, current liabilities. Is it right? Then quick ratio and current liability will give you quick asset. Current liability and quick ratio, quick asset. Current asset and quick asset will give you stock or inventory. Is it right? Inventory and inventory turnover ratio will give you COGS. COGS and gross profit margin, you can find sales. From sales and average collection period, you can find debtors. Is it right? current asset minus debtor minus stock will give you cash and bank. Cash and bank and ratio will give you reserve and surplus. Share capital is already given to you. You will find reserve and surplus. You have found current liability. So you will prepare a balance sheet. What about fixed asset? Fixed asset is balancing figure. Is it right? So will you be able to solve? I'll repeat the answer. You will show it to me, okay? Current ratio and working capital will give you current asset and current liability. Current liability and quick ratio will give you quick asset. Current asset minus quick asset will give you stock. Stock and inventory turnover ratio will give you cost of goods sold. Cost of goods sold, gross profit margin will give you sale. Sale and average collection period will give you debtor. Then cash will be current asset minus debtor minus stock. Reserve and surplus to cash ratio will give you reserve. And then you can prepare balance sheet. Fixed asset is the balancing figure on the asset side. Similar problem we have done, or you can do it. I have given you the answer. Will you try? Very good. Tomorrow you show it to me. I will check your sincerity and dedication. Is it right? Next question, number 25. In this question they have given us current debt to total debt 0.3. Total debt to owner's equity 0.5 and owner's equity is given here at the top 2 lakh. So from owner's equity and this ratio you will be able to get total debt. From total debt and current debt ratio you will get current debt. Am I right? This you will get total and owner's equity. So liability side is over. Total of liability side is equal to total of asset side. Then fixed asset to owner's equity is 0.6. So you can use owner's equity and this ratio to find fixed asset. Total asset turnover is given 2 times. So you can find sales from that, because total asset is equal to total liabilities. Once you get sales, you can get inventory also, because I can't calculate cost of goods sold in this problem. So my sales figure will be based on, come on, sales figure will be based on inventory turnover is, say inventory turnover is based on sales, not cost of goods sold. Sir, why? This is based on sales, because there is no way you can find out the cost of goods sold. GP ratio is not given. Am I right? So what the student will do, please write down quickly balance sheet in your notebook. Balance sheet, and then write this balance sheet. Same balance sheet copy. Question is getting repeated in MTP April 21, March 22. Please copy this balance sheet in the notebook. We are going to solve it. For 4 to 5 marks, they will ask you. 5 marks usually they will ask you, have you drawn the format of balance sheet? Say yes. So once you draw the balance sheet, tell me. In the same format you should draw. If they give you balance sheet format in the question, you will draw the same format in your answer sheet. Is it right? Now we will write down first whatever information is available. So owner's equity data is available 2 lakh. Owner's equity data is available 2 lakh. Write down owner's equity 2 lakh. Other figures we will calculate one by one. Below this balance sheet, you should write working notes. Working notes, working note 1. Always write the heading, calculation of total debt. Okay, heading. After heading, you have to write the ratio given to you. Total debt to owner's equity is equal to 0.5. Second line of the table. Question. Total debt. Presentation is important to get full marks. Owner's equity is 2 lakh. Is 0.5. Therefore, total debt cross multiply 0.5 into 2 lakh is 1 lakh. Okay. Now write down working note 2. Calculation of current debt. So you will write down current debt upon total debt. Question in front of you. Question number 25 is equal to 0.3. So current debt will be equal to 0.3 multiplied by 1 lakh, which is 30,000. Is the answer 30,000? If total debt is 1 lakh and current debt is 30,000, can I find out long-term debt now? So write down long-term debt. Long-term debt. Today as a homework you practice all the questions. All the questions you will practice now. Now you have understood how to solve the problems. Based on whatever learning we had today, you will be able to solve most of the questions. Total debt minus current debt. And you have learned the presentation also. So total debt is 1 lakh. Current debt is 30,000. So long-term debt is 70,000. Is it right? So I will go to the balance sheet now. Current debt 30,000. Long-term debt 70,000. So the total of these two is 1 lakh. In your notebook write down current debt 30,000, long-term debt 70,000, total 1 lakh. 1 lakh plus 2 lakh means owner's equity plus total debt is 3 lakh. If this is 3 lakh, then the asset side will also be 3 lakh. Then the asset side will also be 3 lakh. Is it right? Now once you get the asset, you can find out the total asset to turnover ratio. Sales you can find out. Fixed asset to owner's equity is given. Fixed asset you can find out. Is it right? So are we ready? So write down working note 4. Calculation of fixed asset. Calculation of fixed assets. In the problem given, fixed asset upon owner's equity is how much is given to you? 0.6. Very good. So fixed assets will be equal to 0.6 multiplied by owner's equity 2 lakh. Is it 1,20,000? Point working note 5. total assets. So total assets will be equal to total of liabilities side of balance sheet. Yes or no? So total of the liability side of the balance sheet is 3 lakh. Now there is a ratio total asset turnover 2 times. How many working notes we have prepared? 5. Working note 6. Yes, calculation of sales. Calculation of sales. So sales upon total assets. 2. Sales upon total asset is how much? 3 lakh is equal to 2. Therefore, sales equal to 6 lakh. Is it right? Working notes on calculation of inventory. What is inventory turnover ratio? 10 times. So we will take inventory equal to, this time we are changing the formula, sales upon inventory turnover. How much is sale and how much is inventory turnover? So how much is the answer? 60,000. Write a note here. In the absence of information about cost of goods sold, we have used sales figures. Okay. So this time we are deviating from the normal formula. So write a note. Now write down working note 8. What is missing in the balance sheet now? Let us check first. Fixed asset, how much we have got? So current asset will be 1,80,000. Inventory, how much we have got? 60,000. So cash will be balancing figure. How much is cash? 1,20,000. Is it right? Understandable? Just write one more line. Working note 8. Calculation of current asset. Current asset in this question is equal to total assets. Keep writing. Minus, because we are doing practice. By looking at the answer, you will not learn. You will learn when you solve yourself. So how much was fixed asset? 1,20,000. So what is your current asset? 1,80,000. If you write the answer like this, you get full marks. And this comes with practice. Okay, just reading the answer is not enough. That is what many students do. We are here for practicing. Question number 26. ABC has a total sale of 10 lakh, all of which are credit sale. GP ratio is 25%. Current ratio is 2. Current liabilities are 2 lakh. Further, it has inventory of 80,000 and marketable security of 50,000 and cash of 30. So marketable security is also current asset, part of current asset. They are easily sellable. They can be converted into cash easily. Calculate average inventory if inventory turnover ratio is 3 times. Oh, so easy. From sales, you will get cost of goods sold, and from that you can get average inventory. Am I right? COGS upon inventory turnover is average inventory. Then compute the average collection period if the opening balance of debtor is expected to be 1,50,000. So sale is given. So you can find out first closing debtor. First you'll find closing debtor. Then you'll find average debtor. Average debtor divided by credit sale per day will give you average collection period. So write down little fast. It will take 2 minutes only, don't worry. And if it is asked in the exam, you can quickly get 4 marks. So step number 1 is average inventory. Right hand side rupees. Point A sales. Sale is 10 lakh. Point B less gross profit. Keep writing. Gross profit is 25% of 10 lakh. When we are solving ourselves, it gives us practice. Is it right? And more practice will give you confidence that you can solve. So COGS will be 7,50,000. Then write inventory turnover, which is given in the problem. Inventory turnover is given 3 times. 3 times. So point E average inventory, and you get 2 marks for this much effort. C divided by D. Rupees 2,50,000. Do you agree or don't agree? Step 2. Calculation of closing debtor. Because opening debtor is given, it means they want us to use average receivable for calculating the collection period. Okay. Now how do I reach closing debtor? You are given in the question current liabilities. Yes or no? How much is current liabilities? 2 lakh. And you are given current ratio. Second line of the question. What will you get if you have current liability and current ratio? You can calculate current assets A into B. How much is that? 4 lakh. Now we have got the inventory figure, we have got cash, we have got marketable security. Is it right? So can we not find out the debtor as a balancing figure? Say yes. So point number D, less. Under less write down 1, closing stock, inner column 80,000, cash, inner column 30,000. 3. Marketable security. This is also current asset item. How much is that? 50,000. Read the problem first 3-4 lines. Are they there? So total of these 3 items in the outer column will be 1,60,000. Total current asset minus stock, cash, marketable security. What will you get? You will get closing debtor balance, which is equal to, very good question. With practice you can understand the step. Otherwise most students wonder how do I get the balancing figure. Opening debtor is given in the problem somewhere below. Check how much is opening debtor. Calculation of average debtor, write down now. Average debtor will be opening debtors plus closing debtors divided by 2. How much is opening debtor? Last paragraph of the question. Closing debtor you have computed just now. 2,40,000 divided by 2. Come on. Average. Is it 1,95,000? Step 4 write down, which is your question number 2. Average collection period. Is equal to average debtor divided by average credit sales per day. This is the logic. This is your debtor, this is your average credit sales. So how many days of credit sales are blocked in debtor? That is the logic. If you understand the logic, you can generate the formula yourself. So this is 1,95,000. Sale is 10 lakh. Number of days in the problem 360 is mentioned. Please answer in days. Round off the number of days. 70 days approximately. 4 marks you'll get for this much effort. But only the students who have done prior practice will be able to get it. Any query on this? Question 27, write down homework. Question 27 homework. You will try yourself. It will take some time because you have to compute ratios for all the 3 years. Then compare with the industry and comment on the performance. Is it right? Number question homework. 10 mark question in November 2021 MTP, that was. Now we will solve question 28, and the source of this question is May 18 exam for 5 marks. So now we will take some exam question also. Study material completed, RTP, MTP completed. It is time for some exam questions. So you'll get a feeling of how the questions are asked in the exam. The accountant of Moon Limited has reported the following data. GP margin. So GP plus GP margin will give you what? It will give you sales. It will give you cost of goods sold. And then once you get sales, Using total asset turnover ratio, you will get total assets. Using total assets, you will get net worth. Then current ratio is 1.5:1. Liquid assets to current liability is 1:1. Means only cash and debtor. Cash, bank, debtor, but not stock. Credit sale to total sale is in the ratio of 0.8:1. So you will be able to bifurcate this into cash sales and credit sales. Is it right? And then from credit sale, you will get the debtors. From credit sale, you will get the debtors. Now we'll come to assume 360 days in a year. You are required to prepare balance sheet which has following details. You have to find the net worth, current liabilities, then fixed asset, stock, debtor, cash, and this is the total of the balance sheet. Very good question for exam purpose. For 5 marks, it is a time consuming relatively. Is it right? So what you do, first you copy this balance sheet in your notebook. Please do it fast. I know you are intelligent, but examination is of a different level altogether. Have you drawn the balance sheet format? Can we start now? So start. So write down very important question. First we will calculate step 1 sales. Right hand side rupees. Point A, gross profit 60,000. Gross profit margin is 20%. So can we get the sales figure now? Is 3 lakh. A upon B, easy to understand. Or you can write the formula and solve. Step 2, yeah, working note 2, calculation of total assets. You are given total asset turnover ratio. So sales upon total assets is 0.30. 3 lakh upon total assets is 0.3. Total assets equal to 3 lakh divided by 0.3. Is it 10 lakh? Say yes or no. Step 3, write down calculation of net worth. In the question it is given net worth to total assets. Net worth upon total assets. How much is given? 0.90. Net worth is missing. Divide by 10 lakh is 0.9. So can you tell me net worth? 9 lakh. Step 4, total of liability side will be equal to total assets will be equal to 10 lakh. So step 5 will be current liabilities. So please tell me, how do I reach current liabilities? Total of the liability side is 10 lakh. Net worth is 9 lakh. Current liability. So current liability will be 10 lakh minus 9 lakh is 1 lakh. So first let us come to balance sheet. Is it right? So in balance sheet write down total liabilities 10 lakh, total assets 10 lakh, net worth 9 lakh, current liabilities 1 lakh. Now if you look at the question, current ratio is given. So can I find current assets now? Yes, so I can find step 6 or 7, calculation of current assets. So just write down directly, current assets equal to current liabilities into, current liabilities into current ratio. Do you agree with this formula? Current asset is equal to current liabilities into current ratio. So this is formula only. We have just simplified it. How much is current liability? How much is current liability? And how much is current ratio? This is formula only. 1,50,000. Wait, now write down step 6. Calculation of quick assets. Quick assets. Liquid asset. You are given liquid assets, or write down liquid asset. It is given in the question liquid assets upon current liabilities. Can you see the question? Is equal to 1. So liquid asset will be equal to current liabilities. Yes. So once we get liquid asset, we'll get inventory. You are right. So what is current liability? Is 1 lakh. So liquid asset is 1 lakh. So step number 8 now. Calculation of stock. All this will come through practice. Otherwise in the exam will get stuck. Trust me. Is it right? So how do you get stock now? Current assets minus quick asset. Very good. Current asset is how much? Quick assets are how much? 1 lakh. Previous step. This is your quick asset. 50,000. Quick asset means liquid asset. Is it right? Now step 9 write down. Calculation of debtors. You are given average collection period 60 days. What does average collection period 60 days represent? Credit sale of 60 days are tied up in debtor. Therefore, debtors equal to 60 divided by 360 into credit sales proportionately. Annual credit sale is, we have computed annual credit sale 3 lakh. Is it right? So 3 lakh into 60 by 360. No, wait a minute. There is a small correction required. Credit sale we have not yet calculated. We have been given in the question credit sale to total sale is 0.8. So just multiply by 0.8 also. Yeah, this is now you can do it. Credit sale to total sale is 0.8. So which means credit sale is 80% of 3 lakh. So the answer is 40,000. Okay. Any query on this? We have to be careful. Otherwise here we could have made a mistake. Now we have got the stock, we have got the current asset, we have got data. Can we find out the cash balance? Last step, number 9. Step 10, sorry. Calculation of cash is equal to current asset minus debtor minus stock. 1,50,000 minus 40,000 minus 50,000. Anybody, how much is cash? Cash is 60,000. Yes, balancing figure also, but there will be too many balancing figure then in the balance sheet. Okay. Fixed asset will be balancing figure. One balancing figure is okay. If I write two balancing figure on the asset side, it is confusing. Okay, now you please reply. Stock was how much? 50,000. Debtor was how much? Cash was how much? So fixed asset balancing figure 8,50,000. Is it right? In the exam you will mention the working note number also in front of it. Okay, you can do that much? Louder, yes.
Yes, sir.
Question number 29. November 18 exam 5 marks. And in this question you have to write one more line here which is not there in your book. Calculate. They have given the question and they have not mentioned what you have to calculate. That is interesting. So write down calculate current assets. If your question does not have this line, please write it down. Calculate current asset, comma sales, comma cost of goods sold, stock, debtors and cash. Current asset, sales, COGS, stock, debtor, cash. Right. Now read the problem. Following is the information of XML Limited relating to year ended 31st March 2018. Gross profit is given, net profit is given, inventory holding period is given 3 months, receivable collection period is 3 months, non-current asset to sales ratio is given 1:4, non-current asset to current asset is given 1:2, current ratio is given 2:1, non-current liabilities to current liability 1:1, share capital to reserve and surplus 4:1, and only one amount is given, that is non-current asset, 50 lakh. And from this, you have to find all other figures. So first let us discuss non-current asset will help us to compute sales and we'll get current asset. Okay. From current asset and current ratio, we'll get current liability. From current liability and this ratio, we'll get non-current liability. Is it right? And then if some information missing, we'll check. No change in the non-current asset during 17-18. No depreciation was charged on non-current asset during 17-18. Is it right? So we have to find current asset, which we can find sales, cost of goods sold, stock, debtor and cash. I think some information may be missing. We'll see. So first you start. Write down here non-current asset to sales ratio is given. Can you see that? Sales. So once we get sales figure, we can find out net profit, gross profit, cost of goods sold. Then debtor collection period will help us to get the debtor, stock holding period will help me to get the stock. That is easy. Is it right? So sales figure will be required for first four ratios to be used. So how do I start the problem? You check what is given to you. You are given non-current asset. With non-current asset, what are the ratios given to you? These two ratios are given to you. Is it right? And then you have to create link one after the other. Write down. Very good question. In the exam, the student have to be careful. As I am telling you again and again, now they are asking you reverse questions. This is also reverse question. The previous May 18 exam was also reverse question. Step 1. Calculation of current assets. Non-current assets, current asset. Upon current asset, this ratio is given. Non-current asset is given in the last line on the screen, 50 lakh. This is my starting point. So first we are using this ratio and after that we'll use this ratio to get sales. How much is ratio? Non-current asset to current asset? 1/2. So non-current asset figure you put 50 lakh. Current asset is missing. Is equal to 1/2. Therefore current asset will be 1 crore. Current asset is 1 crore. Step 2, write calculation of sales. So now the ratio is non-current asset upon sales. Look into your question book and tell me what is the ratio given. 1/4. So 50 lakh divided by sales is 1/4. So sales will be equal to 2 crore. Is it right? Now we'll prepare a big working note which will calculate many things. Calculation of COGS, net profit and stock. Gross profit also will calculate. Have they asked you gross profit in the question separately as a heading? No. So don't worry. They've just given it, but we'll require it. Yes, for the calculation of COGS. Right hand side rupees. Any other format is also welcome. Presentation will change. Answer should not change. So first point A, sales. Sale is 2 crore. Less gross profit. First line of the question. 20% into 2 crores. Come on student. 40 lakh. So what is cost of goods sold? 1 crore 60 lakh. Point D is inventory holding period is given to you. How many months inventory holding period? 3 months. Now I am asking you, you reply, if inventory holding period is 3 months, so what will be your average inventory? Inventory holding period will be 3 divided by 12 into COGS. Yes, proportionate. Inventory is equal to 3 months of COGS. So 3 divided by 12 into COGS is how much? The average inventory is 40 lakh. In your question you add one more thing. You have written calculate, write one more item, calculate net profit. So we will write net profit also, because they have asked 10% of 2 crores. So how much will be net profit? 20 lakh. Net profit is 20 lakh. Average inventory you got 40 lakh. Average inventory 40 lakh. Just check you have written everything nicely. Any other presentation is welcome, as long as your answers are correct. Every calculation will be displayed in your answer. Here COGS is A minus B. Okay, can I go to next? What is the next calculation they want? Debtor. Stock we have computed. Is it debtor pending? Yes sir, debtor cash. Debtor is pending. So don't worry. First you write down debtor. To calculate debtor, average collection period is given 3 months. 3 months is given, receivable collection period. Debtor velocity is given. Therefore, debtors, what is the formula? Guide me. 3 by into credit sale. Just check whether cash sale, credit sale, total sale separately mentioned anywhere? No. If nothing is given, all sales are credit sale. How much was your credit sale? 2 crore. Very good. So the answer is it 50 lakh? 50 lakh. One more thing we will compute is your cash they have asked you to calculate. Calculation of cash. Cash is equal to, please help me, help me, help. Current asset minus stock minus, we need to calculate current asset. What was your first step? Current asset only. 1 crore. Where is the stock? 40 lakh. We'll assume average stock and closing stock are same because I don't have opening stock in the problem. So current asset we had computed, I think it was 1 crore. Stock or average stock we have computed 40 lakh. Debtors just above that 50 lakh. So cash and bank 10 lakh. Write a note. It is assumed that there are no other item in current asset. No other items in current asset. So whatever difference is there is cash, because current asset can have other current asset also. Say yes or no. Yes. Any query on this? These are the exam question. Now we'll take one more exam question. May 19 exam, 5 marks. So you should have that confidence that I will be able to solve exam questions. Right. Again, if you see this question, they have done reverse, they have asked reverse calculation. From the ratios, you have to find this figure. When I am sitting in front of you, you are finding easy. When I will give you to do yourself, you will take 1 hour to solve such questions. So please practice. That is the only way you can get good marks. Following figures and ratios are related to company Q Limited. Sales all credit 30 lakh. Sales and GP ratio will give you cost of goods sold. Fixed asset turnover ratio based on cost of goods sold. These two ratio will give you fixed asset. Stock turnover ratio based on cost of goods sold. These two ratio will give you stock. Then liquid ratio 1:1. Current ratio 1.5:1. Debtor collection period 2 months. So debtor and sales together will give me debtor balance. Reserve and surplus to share capital 0.6:1. Okay. Then capital gearing ratio 0.5. Capital gearing ratio means debt plus preference share capital upon net worth. That is called capital gearing ratio. Then fixed asset to net worth is 1.20. So you have got fixed asset here. Now you can get net worth. Is it right? So net worth will get. Then current asset, fixed asset, closing stock. 5 items you have to find, and you will get only 5 marks. Is it right? So how do you solve? Begin. How will you find current asset? We will see. Can you tell me how will you find current asset? So we will find stock, debtors we can find, Yes. So start with COGS first. Okay. Step 1, calculation of COGS and stock. Calculation of COGS and stock. So write down first sales. Sales less gross profit. So how much is gross profit at the rate of 25%? 7,50,000. So COGS is how much? 22,50,000. And what is the stock turnover ratio? Is 6 times. Therefore, stock, you will write point number A, B, C, D, E. So that is C by D. How much? 3,75,000. Is it right? Step 2, calculation of fixed asset. You are given fixed asset turnover ratio based on cost of goods sold. So fixed asset will be equal to COGS upon fixed asset turnover ratio. COGS is how much? Okay, and turnover is how much? What is the answer? 15 lakh. Now write down step 3, calculation of debtors. Calculation of debtors. Average collection period. Average collection period is 2 months. Therefore, debtor will be equal to how much? 2 by 12 into credit sale. 2 by 12 into how much is credit sale? 30 lakh. So 5 lakh. So you got the debtors also. Now one ratio in the last given, fixed asset to net worth 1.20 is to 1. Fixed asset we have got it. Net worth I can find out using this ratio and fixed asset figure, we can find net worth. So step number 4, calculation of net worth. Fixed asset upon net worth 1.2. Fixed asset was how much? Fixed asset was 15 lakh upon net worth is 1.2. Yes student, what is net worth equal to? 15 lakh divided by 1.2 is 12 lakh 50,000. So now out of this 5 requirement, how much we have computed? Closing stock is over. First answer was closing stock. Fixed asset is over. Debtor is over. Net worth is over. Now we have to find current asset. For that, I have to use current ratio. I have to use liquid ratio. And I have to use the stock figure. So you will be able to find current asset. So last step 5, calculation of current assets given. Wait. Current ratio is how much? 1.5 is to 1. Liquid ratio is how much? 1. Stock, how much you have computed? Stock we have computed 3 lakh. You don't have current liabilities. So try yourself now. Eleven lakh 25,000. How come you got 11 lakh 25,000? Please explain to the class. Yeah, it is correct, but then you have to explain. Quick asset upon current liability. X is equal to current asset. X minus stock upon current liability equal to 1. Second equation. Current ratio. X upon Y equal to 1.5. Y is equal to current liability. So suppose let current asset be 1.5x and current liability is equal to x. Can we write like this? Same thing. Okay. Then in liquid ratio is equal to current asset minus stock upon current liability. Liquid ratio is 1. Current asset is 1.5x. Stock is 3,75,000. Current liability we have assumed as x. So now you solve this equation. It will become x equal to 1.5x minus 3,75,000. So x will be equal to how much now? 7,50,000. Liquid ratio is 1. So x equal to, you said 7,50,000. That is your liability. That is your current liability. Okay. Is it 3,75,000 or 7,50,000? Is this ratio right? You have checked the calculation? If current liability is 7,50,000, current ratio will be 1.5 times of 7,50,000. So write down below. Therefore, current asset equal to 7,50,000 into 1.5 is how much? 11,25,000. This is right. So this was a new calculation for you. Is it right? Any query on this? No query. Okay, come to January 2021 exam for 5 marks. Question number 31. Equity share capital is 2 lakh. Total debt to owner's equity 0.75. Total debt to owner's equity 0.75. Total asset turnover is 2 times. Inventory turnover is 8 times. Fixed asset to owner's equity is 0.6. And current debt to total debt is 0.4. This question we have done earlier also. So write down homework. If you can't calculate COGS, we will take sales. As I said, we have done this question earlier. Just try to locate which was that question. A very similar question. Number 25 we have solved today. Same as 25. Write down. So 25 number was asked in MTP, and then as I said, they will shift it to the exam also. Is it right? Only what they have done, they have changed some figures. Not even figures. Most of the figures are also same. There also share capital is 2 lakh. Here also share capital is 2 lakh. Institute will repeat the question. That is my whole idea, to give you the practice. Get confidence. So 31 and 25 are similar problem. So write down homework 31. Do it like 25. I have done it for you already. Now we'll take one question from July 21 exam. Sir, why not May? Because exam was postponed. Is it right? The world was suffering from Corona 2, Part 2. Corona 1 was 2020. Corona 2 was 2021. We have to be careful. Yes. Now we'll come to Masco Limited has furnished the following ratio and information relating to year ended 31st March 2021 sales, return on net worth, then rate of income tax, share capital to reserve, current ratio, net profit to sales after tax, inventory turnover ratio based on cost of goods sold, and then cost of goods sold is directly given to you, so you can find the stock, average stock. Interest on debenture is given, receivable is given 2 lakh, and out of that debtor is 1,25,000, payable is given 2,50,000, and bank overdraft is given. So these two together are current liabilities. And once you got current liability, there is a current ratio here. You can get current asset. Is it right? And then the question is calculate the operating expense for the year ended 31st March 2021 and prepare a balance sheet in the following format. So when they give you the format, you follow that format. This is the balance sheet format you have to solve. So what we will do, we'll prepare two things. One will prepare balance sheet, one will prepare profit and loss. So balance sheet to draw as per this question. You can see this is a exam question for 10 marks. Draw the same balance sheet first. A very interesting question for finding the missing figures. First you draw the balance sheet, then I will guide you further. Very important question for revision purpose also. Write neatly. You can draw two columns if you want. One inner column, one outer column. Okay. Then we'll prepare one trading and profit and loss account. Or you can prepare in a vertical format also, both are okay. Our objective is to find operating expense. Is it right? So whether I prepare a vertical format or this T format. Trading and P&L account you've written. So first I will put whatever information is available with me. So sales figure is available. Can you see sales in the question? How much is sales? How much is sale? To cost of goods sold. Is it given below? 22,50,000. And interest on debenture, can I write in P&L account? To interest on debenture, is it 75,000? Then in balance sheet, can we write receivable 2 lakh? In the inner column, receivable 2 lakh. Payable is also given. How much is payable? 2,50,000. Bank term loan is how much? Actually, they have written by mistake bank term loan. It should be in bracket bank OD. There is a typing error in the question. Means institute's mistake. What they want to say is bank overdraft. So that is 1,50,000. Bank overdraft is short term. You have to take it for a short period, return it back once you get cash in your account, return it back. Okay. So there was a mistake in the question. So my current liability is 4 lakh. Now we have to find out the missing figures. So how do I find the missing figure? One by one. Let us see which ratios are given. Sales is given. Return on net worth is given. Rate of income tax is given. Share capital to reserve is given. Current ratio is given. Net profit to sales is given. So can I find out in the P&L account net profit figure? Right here, P&L account to net profit, that is profit after tax, which is 6.5% of 75 lakh. How much is that? 487,500. So I can compute the income tax also here. Income tax will be 487,500 divide by, what is the rate of tax? 50%. Is it 50%? So this amount has been arrived at after deducting 50% tax. So understand, if PBT is 100, tax is 50, PAT will be 50. So I will divide by 50% and multiply by 50%. So same 487,500. Sales is given, cost of goods sold you have been given. So can we write gross profit here? Anybody? Gross profit. 75 lakh minus 22 lakh 50,000. 52 lakh 50,000. By gross profit brought down. 52 lakh 50,000. So balancing figure is operating expense here. Operating expense balancing figure. Is it 42 lakh? This was your first question. So write 42 lakh balancing figure is your operating expense. Any query on that? Now if you look at the question, we have got net profit 487,500, which is net profit return. Return on net worth is 25%. So can I find out the net worth now? Right. Working note 1. Calculation of net worth. Return on net worth is 25%, which means PAT upon net worth is 25%. PAT we have got it. How much was PAT? 487,500 divide by net worth. So how much is net worth now? Is it 19,50,000? Then write down, given share capital to reserve. Share capital to reserve is how much given? 6:4. Therefore, share capital will be 6 by 10 into 19,50,000. Net worth has to be broken into two parts. Anybody wants to answer? 11,70,000. And reserves will be 4 by 10 into 19,50,000. 7,80,000. Then working note 2, write down calculation of debenture. So debenture amount will be equal to interest upon rate of interest. Am I right? Interest upon rate of interest. So interest you have been given in the problem. In the question it is given 75,000. Rate of interest is given in that balance sheet which is given in question. Is it 15%? So learned student will reply, what will be debenture amount now? Is it 5 lakh? Say yes. So I'll first go to balance sheet. In balance sheet now write down share capital, how much we have computed? Share 11,70,000. Reserve, how much you have computed? 7,80,000. Debenture, how much you have computed? 5 lakh. So can I take the total of the liability side now? 28,50,000, which will also be asset side 28,50,000. Now what is pending? Fixed asset is pending, stock is pending, cash is pending. Did we calculate stock also or not yet? Not yet. Okay, so how do I reach the stock figure? Cost of goods sold is given. Interest on debenture, receivable, trade payable, overdraft. Current liability we have got, so we can use current ratio and find out. An inventory turnover is given, so we can find out the inventory also. Write down working note 3, calculation of inventory. So inventory will be equal to COGS upon inventory turnover. So they will give you enough hint. With your intelligence you can solve. COGS is also given in question, 22,50,000, and inventory turnover is also given 12 times. So the learned student will reply now 187,500. Is it 187,500? Yes. Now I'll find current ratio is given, current liability is given. So can we find the current asset figure now? Yes. So write down working note number 4. Calculation of current asset. First write down current ratio equal to current assets upon current liabilities. Current assets upon current liabilities. Current ratio was given how much? 2.5. Current asset is missing. In current liability we have two items. One is payable 2,50,000 and one is bank overdraft 1,50,000. Therefore current asset anybody is 10 lakh. And one more working note 5, write down cash. Cash is equal to current asset minus receivable, which is given in the problem, minus stock, which we have calculated. So current asset is 10 lakh. Receivable is given to you how much? 2 lakh. And stock you have computed how much? So what will be cash in hand? 6,12,500. Fixed asset will be balancing figure. So please come to balance sheet. Cash you said 187,500. No, stock 187,500. 6,12,500. So total current asset is how much? 10 lakh. If this is 10 lakh, so this you write balancing figure. 18 lakh 50,000 balancing figure sign also. Enjoyed? So we have solved how many questions? 32 questions. Now we will continue tomorrow. Okay, welcome back to this wonderful chapter, cost of capital. Cost of capital revision today. Very important chapter. So those who are interested can write down, or there is a formula book. You can refer the formula book. It is written there. All the formula we will revise. We will take few questions also. Okay, are you ready?
Yes, sir.
So first we will see the formula for cost of irredeemable debt. Cost of irredeemable debt. Cost of capital chapter, first step is to find out the cost of specific source of finance. Under that, cost of irredeemable debt. How will you know that it is an irredeemable debt in the problem? When the number of years are not given. When the number of years are not given. So formula is KD is equal to I into 1 minus T, T means tax rate, divided by net proceed or current market price, or current market price. If net proceed is not given, then current market price, and net proceed is equal to issue price minus flotation cost. Issue price minus flotation cost. Flotation cost means issue expenses like brokerage and commission. Okay. Then we will see cost of redeemable debt. Cost of redeemable debt. So here we have two formulae. First formula is KD is equal to I into 1 minus T plus RV minus NP divided by N, and this whole thing divided by RV plus NP by 2. What is RV? Redemption value. If redemption value is not given, then it is assumed to be at par. And what is the second formula? KD is equal to I into 1 minus T plus RV minus NP upon N, this also into 1 minus T divided by RV plus NP by 2. If difference between RV and NP can be amortized for tax purpose, then you have to use second formula. Otherwise, whichever formula you will use, write the assumption. This formula gives you approximate answer, and for accurate answer, the third method is called yield to maturity, YTM, or IRR method. IRR means internal rate of return. If the problem is specifically ask you internal rate of return method, which they have asked in the exam, then you follow the same. The formula for IRR is lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate minus NPV at higher discount rate into higher discount rate minus lower discount rate. Right? This formula can be used anytime for finding the cost of debt. Now we'll write cost of preference share capital. Cost of preference share capital, under that A, irredeemable preference share capital, number of years are not given in the problem, then in that case cost of preference share will be equal to preference dividend upon net proceed or current market price. Net proceed or current market price. Net proceed means issue price minus flotation cost. Yes. And B, write down redeemable preference share capital. So cost of preference share will be equal to preference dividend plus RV minus NP upon N. N means number of years, divide by RV plus NP by 2. RV means redemption value. If redemption value is not given, assume redemption is at par. And third method is called YTM or IRR method. Same formula written above for YTM or IRR. If NP and current market price both are not given, then take face value. Okay, if NP and current market price both are not given, then take face value. Okay, so up to Preference share, any problem? Now we'll revise cost of equity shares. Write in good handwriting. Revise one day before the exam. Cost of equity share capital. So under this we have different approaches. One is called dividend price approach or dividend discount model. Or discounted cash flow model. So if the institute uses dividend price approach, dividend discount model, discounted cash flow model, then use this. Under this also we have first situation, constant dividend. Dividend remains constant. Okay, no growth, bracket no growth, zero growth. So cost of equity will be equal to dividend upon price. Dividend upon price. Then write down in case of new issue or fresh issue of share, cost of equity will be dividend upon current price minus F, where F is flotation cost, where F is flotation cost in case of new issue. And second, write down dividend growing at a constant rate. Dividend growing at a constant rate. So this is called growth model, also called Gordon model, also called Gordon model. So the formula here is cost of equity equal to D1 upon P0 plus G. D1 is equal to D0 into 1 plus G. If last year dividend is given, it is D0, convert into D1, convert into D1. If next year or expected dividend is given, then it is D1. Then it is D1. Then write down growth rate G is equal to B into R, where B is equal to retention ratio. If suppose in some problem growth rate is not given to you directly, so in B is retention ratio is equal to 100 minus dividend payout ratio, 100 minus dividend payout ratio, and R is called return on equity, return on equity. Dividend payout ratio is equal to DPS upon EPS. Dividend payout ratio equal to DPS upon EPS. Interested candidate can write down in good handwriting. Are you writing?
Yes, sir.
Is it over? Okay. Then write down alternative formula for growth rate. G is equal to future value upon present value to the power 1 by n minus 1. Is it right? For example, they will say in 2021 EPS was, for example, 10. Don't write now. This you don't have to write. And in 2026 EPS is, for example, 15.5. So what you will do, you will take in such question 15.5 divide by 10 to the power, you have to see how many years are there, 5 years minus 1, and then solve this equation, you will get the growth rate. Okay. So depending upon the question, growth rate can be found out by applying this formula or the formula B into R. So this was about dividend discount model. Second, write down, this was point A here. So now point B is called earning price approach. Earning price approach. So here also we will write two formula. One is constant EPS, no growth. Then the formula is cost of equity equal to EPS upon price, or 1 by price earning ratio. Both are same. Or 1 by price earning ratio. And second formula is growth approach. So the growth approach K is equal to EPS upon price plus G. EPS upon price plus G. Right. So this was earning price approach. Now the next approach is called realized yield approach. Realized yield approach, it is based on past return. It is based on past return. Okay. Then write down A. If data of 1 year is given, if data of 1 year is given, then return is equal to D1 plus P1 minus P0 divided by P0. So what is D1? D1 means dividend. P1 means price at the end, and P0 means price at the beginning. P1 minus P0 is capital gain or loss. So return comes in two form, one in the form of dividend, one in the form of capital gain or loss. Okay. If more than 1 year data is given, then one method is use IRR technique. If more than 1 year data is given, you can use IRR technique, or calculate return of each year, and we have to complete the sentence. Calculate return of each year and calculate average return or geometric mean. Average return or geometric mean. Average return or geometric mean. Is it right? So average return will be simple average return. Return of year 1, return of year 2, up to return of year n. Suppose 5 year is given. So first to compute individual year return by this formula, and then take the simple average by dividing by number of years. Okay. Or you can compute geometric mean. Geometric mean. So geometric mean is 1 plus R1 into 1 plus R2 into 1 plus R3 dash dash into 1 plus Rn, and the whole thing to the power 1 by n minus 1. This is how we compute the geometric mean. Is it right? Yes, sir. So these are the formulae for realized yield approach. Now next we will see fourth approach called capital asset pricing model. Capital asset pricing model called CAPM. So here the cost of equity is RF plus beta into RM minus RF. RF means risk-free return. Risk-free return means return on government security. For example, treasury bond. B is beta. Beta is equal to systematic risk, and RM is equal to return on market portfolio. Return on market portfolio. RM minus RF is market risk premium. So if the problem says market risk premium, it means RF is already deducted. Do not again deduct RF. Okay. So these are the formula for computing cost of equity. Now write down cost of retained earning. Cost of retained earning, KR is equal to KE. KR is equal to KE. Except in case of retained earning, flotation cost is not involved. Flotation cost is not involved. Flotation cost is not involved. Okay. Any query? Then write down, if personal income tax is also considered, if personal income tax is also considered, then cost of retained earning is cost of equity into 1 minus TP into 1 minus F. So what is TP here? TP here is rate of personal income tax. Very rarely asked. And what is F? F is the rate of flotation cost. So this formula is from investor's point of view. In bracket, this formula is from investor's point of view, because investor will receive dividend and he will have to pay tax on dividend. Investor will receive dividend and he will have to pay tax on dividend. Otherwise, for retained earning, the formula will be same as cost of equity. Retained earning represents opportunity cost of equity shareholder. So cost of retained earning is taken same as cost of equity. But the benefit of retained earning is that there is no flotation cost. Is it right? So after we will compute one more thing, write down cost of term loan. In some problem, term loan is given. So here the cost of term loan is simply interest rate into 1 minus tax rate. I stands for interest rate and T stands for tax rate, because interest is tax deductible. After that we have weighted average cost of capital. The next heading is weighted average cost of capital, which is called WACC. Is it right? So here what we do, we compute the weighted average cost of various sources of finance. So WACC will be equal to cost of debt into weight of debt plus cost of preference share into weight of preference share. plus cost of equity into weight of equity. Okay. And how do you usually solve? We solve by preparing a table. Either you can use the formula or you can prepare the table. How many columns we will draw? Source, amount, weight, cost, weight into cost. Highly tested in the exam. In source, whatever source they have given, equity, debenture, preference share. Write amount, take total. Amount of equity divided by total is weight of equity. Write cost, multiply. This total is called weighted average cost of capital. Is it right? There are two approaches. Which are the two approaches? One, book value weights, and second, write down market value weights. Book value weights and market value weights. So what is book value weights? It is taken from books of account. It is taken from balance sheet. And market value weights means we will calculate the market value of different sources of finance. Is it right? So write note here. If market value weights are used, then market value is equal to number of security into market value per unit. Yes or no?
Yes, sir.
So suppose there are 60,000 share. 60,000 into market price is 250 into 250. Okay. Now write down next note. If market value weights are used, are you writing?
Yes, sir.
If market value weights are used, do not consider retained earning or reserves and surplus in source column. Or reserve and surplus in source column. But if the cost of equity share capital and cost of retained earning are different, if suppose the cost of equity share capital and cost of retained earning are different, KE is different from KR, then the market value of equity is apportioned between share capital and reserves and surplus in the ratio of book value. In the ratio of book value. Do you remember something like this? You might have studied. Yes. Otherwise, you can just write equity in place of equity, share capital and reserve. But if the cost of equity and cost of reserves are different, then the student will have to divide the total market value of equity share in the ratio of book value. Okay. And one more thing, write down. Marginal cost of capital, MCC. So right here it is the cost of raising additional capital. Cost of raising additional capital. Here weight will be actual funds raised. Weights will be actual fund raised. MCC will be equal to WACC when weight and cost of each source of finance are same. Is it right? If the cost and weight of each source of finance are same. Okay. If the problem says existing capital structure is optimum, if the question says existing capital structure is optimum, then use the weight of existing capital structure, use the weights of existing capital structure for calculation of MCC, for calculation of MCC. One more point. If you have to find the capital investment required without raising fresh equity, then value of capital investment equal to is equal to retained earning used for capital investment, retained earning used for capital investment divided by proportion of equity in total capital structure. Is it right? If the problem says what is the maximum value of a capital investment when we don't have to issue fresh equity, it is only funded from retained earning. So retained earning available for capital budgeting divide by proportion of retained earning in the total capital structure. So you don't have to issue fresh equity. But if your value of capital investment is more than this, then you will have to issue fresh equity. Is it right? So now we'll take some questions for revision purpose. Are you ready?
Yes, sir.
So kindly come to our book. Question number 40 will solve immediately. Question number 40 is from April 22 MTP for 10 marks. The capital structure of RV Limited on 31st March 2022 as per its balance sheet is as follows. Equity share capital is 25 lakh rupees. Face value is 10 rupees. So how many numbers are there? 2,50,000. 10% preference share of 100 rupees each. 5 lakh divide by 100. Come on. 5,000 preference shares. Very good. Retained earning, let it be. Debenture of 100 rupees each. 20 lakh. So there are 20,000 numbers of debenture. Why we need this? To compute market value. Okay. The market price of equity share is 50. This is P0. Expected dividend. Expected what means next year dividend. D1 is expected to be 3. Dividend per share is expected to grow at the rate of 8%. G is 8. So how will you use this information? To find cost of equity. Is it right? Preference shares are redeemable after 8 years and the current price is 80 per share. So this will be required for cost of preference share. So it is a question of redeemable preference share. In this question we will be able to revise many concepts. Debentures are redeemable after 5 years. This is 5. Currently selling at 90 per debenture. So current price of debenture and current price of preference share will be used in place of net proceed in the formula and will also be used for calculation of weights based on market value. Is it right? Tax rate is 35%. This I will require for debenture. Compute WSCC using book value proportion and using market value proportion. What is my first task? To calculate cost of each source of finance. What is my second task? To calculate WSCC. This will give you 10 marks. So do you want 10 marks? Say yes or no. Yes. Right. First write down cost of equity share capital. So which approach we will use? Dividend price approach. Using dividend price approach because data is given for dividend price approach. Cost of equity equal to D1 by P0 plus G. So what is the cost of equity? What is D1 in our question? 3 rupees. What is P0? 50. Growth rate is how much? 8%, 0.08. So that comes to 14%. Then second question, or second, calculate cost of preference share. Redeemable preference share. The formula for this is preference dividend plus RV minus NP upon N upon RV plus NP by 2. RV means redemption value, NP means net proceed. If net proceed is not given, we can use the current market price. How much is preference dividend? Give me the answer. Preference dividend per share 10 rupees. Write down 10 rupees. What is redemption value? 100. Net proceed is not given. Current price is 80. Number of years are 8. Divide by 100 plus 80 by 2. Give me the final answer in percentage term. So can we write 13.89%? Approximately 13.89. And the third instrument is debenture. So write down cost of redeemable debenture. Cost of redeemable debenture. KD is equal to formula I into 1 minus T plus RV minus NP upon N upon RV plus NP by 2. How much is the interest rate? 13% of 100, 13 rupees. What is tax rate? 35%. 1 minus 0.35 plus redemption value 100, net proceed, current market price 90, number of years 5 years, 5 years. Divide by 100 plus 90 by 2. Into 100. Final answer will be in percentage. 11%. 11%. Write one note. It is assumed that difference between redemption value and net proceed is not amortized for tax purpose. Is not amortized for tax purpose. Okay. So we have not multiplied this by 1 minus T. You can solve by that also. Now any query? No. So we'll compute now WACC at book value also and market value also. So write calculation of weighted average cost of capital. Calculation of weighted average cost of capital. First we'll write source, then write cost, then write book value weights. Under that we'll draw 3 columns: amount, weight, weight into cost. It will save time in the exam. You want to prepare two separate table, you can do it. And then write market value weights. Write market value weights, 3 columns again. Amount, weight, weight into cost. Cost column is common for both. Yes. Keep one line blank when you write the source. Are you ready? So we have total 4 sources. Copy in the same order from the question. Keep question in front of you. Equity shares, preference shares, one line blank, then retained earning, and then 13% debenture. This is how you can write nicely and get good marks. So first you tell me cost of equity share in our first step. 14%. Cost of preference share 13.89. What about cost of retained earnings? Same as equity share because there is no flotation. And debenture, it is 11%. Amount copy from the book. You can write rupees in lakhs here. Rupees in lakhs. 25, 5, 20. Total. Anybody total 55 lakh? And then how to write weight in quick format? 25 by 55, 5 by 55, 5 by 55, 20 by 55. Now, dear student, take your calculator, multiply cost into weight. And give me the answer. Do not multiply by percentage sign, just multiply 14 into 25 by 55. 6.36 is right. Come on, next. 1.26. Come on, next. 1.27. Come on, next. 3.40. Exact 4. 3.4. So WACC equal to 12.9%. Approx write down in bracket. Any query? Now what about the market value? How many equity shares are there? There are 2,50,000 equity shares are there. And what is the price per share? 50. So multiply and answer in rupees in lakhs. So is it 125? How many preference shares are there? 5,000 into price is 80 rupees in lakhs, 4 lakhs. How many? Retained earning will not write because cost of retained earning and cost of equity share are same. So when both are same, everything is covered in the cost of equity here only. Otherwise we'll have to bifurcate, but the answer will not change. So therefore we will not write retained earning when we are taking market value of equity share. The market value is for entire equity shareholders fund, not separately for equity share and retained earning. Come on student. Debenture, how many debentures are there? 20,000
20,000 debentures, 90 per day.
into 90. Come on.
20 to 90,
Is it 18 lakh? Just write 18. Because we are writing in lakhs. 125 plus 4 plus 18. 147.
22, 147.
Wait, write down 125 by 147. 4 by 147. 18 by 147. Now students, please answer. Multiply weight into this cost column, second column. 11.9 is right. Come on, next.
0.3.8.
0.38. 0.38. Very good. Next. Last one.
So 1.35.
1.35. Total.
13.63.
13.63% approximately. This is WACC equal to around 13.63%. Is it right? Say yes. Now we'll come to question number 38. December 2021 exam for 5 marks. Question 38 in your book. Question number 38. You will find it. Have you found it? Say yes.
Yes, sir.
Book value of capital structure of B Limited is as follows. 12% 6,000 debenture of 100 rupees each.
Yes, sir.
Retained earning equity shares of 100 rupees each. Currently the market value of debenture is rupees 110 per debenture and market value of equity share is 180 per debenture. Expected return of equity shareholder is 24%. What is this? Expected rate of return of equity shareholder is 24% per annum. This is cost of equity. This is cost of equity. Cost of equity is the expected return of equity shareholder. So here the new thing they have mentioned is this line, which means the expectation of equity shareholder is the cost to the company. Company is paying tax at the rate of 30%. Why this is given? For calculating cost of debenture. Compute WACC using market value weights. Is it right? So how do we solve it? So we'll have to find cost of debt first. Is it right? After computing cost of debt, cost of equity is already given to you. Or cost of equity, expected rate of return of equity shareholder is 24% per annum. So this is they have not mentioned it clearly.
Interest rate.
Whether it is dividend rate or whether it is final return expected by the investor. So as per the institute answer, if we see, they have assumed it to be dividend per share. They have used it for calculating dividend per share. Okay. So write. First write down step 1. Calculation of cost of. Now tell me, is it a redeemable or irredeemable debenture?
Irredeemable.
Because the number of years are not given. So we'll use the formula for irredeemable debenture. KD is equal to
KD equals to I into 1 minus T.
1 minus T upon net proceed. If net proceed is not given, you can take current market price. You can take current market price. Interest rate is 12%. 12% of 100, 12 rupees.
12 rupees.
Tax rate is how much?
So it is 31, 0.3.
0.3. Net proceed is not given, but current price of debenture is 110. 110.
Yes, sir.
Can you see that?
Yes.
Question number 38. December exam for 5 marks. So how much is that?
7.64%.
So can I write 7.64%?
Yes, sir.
Step 2, write down calculation of cost of equity share. Write a note. It is given that expected rate of return of equity shareholder is 24% per annum, right?
Yes, sir.
Expected rate of return of equity shareholder is 24% per annum. It can be interpreted in two ways. It can be interpreted in two ways. One, 24% is the rate of dividend, and second interpretation is 24% is the cost of equity. ICI has assumed it to be rate of dividend.
So if we'll take the first situation, that 24% is the rate of dividend. So
Then I am solving. This we are going to solve by this assumption. ICI has assumed it to be rate of dividend. We will also assume the same. Otherwise, in the exam, if you want to solve by this, write the assumption accordingly, because the expectation of the shareholder is the cost of equity for the company. Okay. First you complete writing. In case if you have doubt, you can ask me now, you can ask me later. Okay, so now write down below that cost of equity equal to dividend upon current share price. Dividend will be 24% of 100 rupees, 24 rupees. Share price is 180, and then multiply by 100, you will get in percentage.
0.34%.
How much?
13.34%.
13.34 percentage.
Yes.
Now write down WACC, market value weights. WACC using market value weights. Write down source, amount, weight, cost, weight into cost. Source, write down debenture and equity. There are 6,000 debenture and the market price is 110. So that comes to 6,60,000. How many equity shares are there?
4,500.
4,500 into market price is 180. So 8,10,000. So can you tell me the total? 14,70,000. So the weight will be 66 divided by 147, 81 divided by 147. Retained earning will not write because we are using market value weights. How much is cost of debenture we have computed?
7.64%.
7.64%. And what is this? 13.34%. So what you do, multiply 66 on your calculator, divide by 147 into 7.64 equal to
It is equal to 3.43.
3.43. 81 divided by 147
7.35.
into 13.34. 7.35.
10.78.
So 10.78%. This is your WACC. Then write below. Any query?
No, sir.
Write below. If we assume K is equal to 24%, then WACC will be, if we assume K is equal to 24%, write 4 columns: source, weight, cost, weight into cost. Source, write down debt, equity. What will be the weight? Weight will be same, weight will not change. 66 by 147, 81 by 147. Cost of debt will take same, 7.64. But cost of equity we will take now 24. This we are changing. This is second interpretation. Multiply. This will be same what you have written here, 3.43. It can't change. 13.22. So by a different assumption, the answer will be 16.65%. 16.65%. Now we'll take one November 2020 exam, 4 marks. Just check this question is there in the last. What is the number? One more variety. Question number 47. For 4 marks, November 2022 exam. Is it right? MR Limited is having the following capital structure, which is considered to be optimum. Underline. Optimum means best. So the new funds will be raised in the same ratio. So this question is based on marginal cost of capital. As on 31st March 2022, equity share capital 50,000 share 8 lakh, 12% preference share 50,000, 15% debenture 1,50,000, total 10 lakh. So what is the weight, can you tell me? 8 lakh divided by 10 lakh, 0.8. 50,000 divided by 10 lakh,
0.05.
0.05. 0.15. Is the total equal to 1? So these are the weights of these three sources when the capital structure is optimum. So it means if they want to raise fresh capital, they would try to keep the ratio same. A company which has identified that this is the optimum capital structure, then they will try to maintain the same. So new funds will also be raised in the same proportion. That is the purpose of using the term optimum there. The earning per share of the company were 2.50 in 2021 and the expected growth in equity dividend is 10%. So growth rate is given 10%. EPS is given for 2021 2.50. The next year dividend per share is 50% of the EPS of year 2021. So D1 is equal to 50% of 2.50. So that will come to 1.25. Current market price is 25. P0 is given 25. Then the problem says 15% new debenture. So they want to increase their capital, can be issued by the company. Company's debentures are currently selling at rupees 96. So you can use these two for finding cost of debt. The new, again new, 12% preference share can be sold at a net price of 91.50. Face value is 100. So this you can use for finding cost of preference share. We can find cost of equity, cost of debenture, cost of preference share. For debenture, you will require tax rate of 30% because interest is tax deductible expenditure. So again in this question, we will learn the calculation of cost of equity, cost of debenture and cost of preference share. You are required to calculate after tax cost of new debt, preference share, equity share, assuming that new equity share comes from retained earning, means no flotation cost. No flotation cost. Then you have to compute marginal cost of capital. For marginal cost of capital, weight will be same which is used by the company right now, and cost of debt, preference and equity will come from previous working note. Okay. Then one more intelligent question for you. How much can be spent for capital investment before sale of new equity share, assuming that retained earning for next year investment is 50% of 2021. 50% of 2021 EPS. 50% of 2021 EPS. So what is the EPS of 2021? 2.50 into 50% into number of shares 50,000. This much retained earning they can use.
Okay.
And then you divide by the proportion of equity, that is 80%. So that will give you the amount that can be spent on capital expenditure without issuing fresh share. Without issuing fresh share, because you can finance it out of retained earning. Is it right? So first calculate how much retained earning is available, divide by proportion of retained earning. That will give you the value of capital investment without issuing fresh equity shares. Okay. Similar question is given in your study material of the institute also, and they've asked in the exam also. Let us solve in the notebook, right? please write down because such questions are getting asked in the exam. So we'll first find out cost of debt, equity and preference share. Are you ready? So write down cost of new debt. Cost of new debt KD is equal to I into 1 minus T upon P0. I into 1 minus T upon P0, because number of years are not mentioned in the problem. If number of years are not mentioned in the problem, then apply irredeemable debt formula. So interest rate is 15% on new debenture into 1 minus 0.3 divide by 96 into 100 so please solve. Around 10.9375% you are getting. 10.9375%. Yes, write down. Then you write down cost of new preference share 10.9375. Yes, come on, next step 2. If you write step by step, you get more marks. Cost of new preference share. Right, cost of new preference share KP is equal to PD upon P0. PD upon P0. Preference dividend on the new preference share would be 12 rupees and its price is 91.50. So divide by 91.50, multiply by 100, you will get 13.1148%. Is right, 13.1148%. 13.1148%. Step 3, write down. Step 3, write down cost of new equity share. So under that, first we'll write down the basic data. Growth rate in dividend is given G. Growth rate in dividend is given, bracket G, is 10%. Next year dividend D1 is equal to 50% of year 2021 EPS. 50% of year 2021 EPS. 50% of 2.50. 50% of 2.50. 1.25. Then write down, therefore K is equal to D1 upon P0 plus G. D1 upon P0 plus G. 1.25 divided by 25 plus 0.10. Solve. How much do you get? 15%. Write down properly 15%. Presentation in detail is important to get full marks. Now write down step 4, which is our next question. Compute marginal cost of capital. Write down marginal cost of capital. MCC. Don't write W, just write MCC. In bracket write down, assuming company maintain same weight as that of existing capital structure, as that of existing capital structure. So first you write down the columns: source, weight, specific cost, weight into cost. Source, write equity share, one line blank, 12% preference share, one line blank, 15% debenture. Weight, how do you compute weight? Go to the question. You will see equity share is 8 lakh and total is 10 lakh. So we will assume the weight of new capital is going to be the same. So 0.8. So this is a question on marginal cost of capital. Next one, 50,000 divided by 10 lakh. 0.05. 1,50,000 divided by 10 lakh. 0.15. Specific cost we have computed. Equity is 15%. Preference is 13.1148%. And debenture is 10.9375%. You can round off in 2 digits if you want. No problem with that. Now your task is to multiply and take the total. Let us see who will do it first. Come on, come on, come on. First one, 12. Very good. Next. 0.65 or 66 is welcome. Third one, third one, third one. Come on, third one. 1.64. Total. Make it 14.3%. So MCC equal to 14.3%. MCC equal to 14.3% bracket approx. And now we have to find out that what can be the maximum value of capital investment project we can undertake, but we don't have to issue fresh equity shares. So for that purpose, we will see that how much retained earning can be used next year, and the proportion of retained earning in the total capital structure is 80%. So we'll divide by 80% because the company will always use the 3 sources of finance in the same proportion because it is optimum. Okay, write down the heading. Step number 5. If step number 5, write down calculation of amount that can be spent. Calculation of amount that can be spent for capital investment. That can be spent for capital investment before sale of new equity shares. Before sale of new equity shares. So first we write down EPS of year 2021. EPS of year 2021 is 2.50. Number of equity shares 50,000. Number of equity shares 50,000. Point C, total earning A into B. Write in detail. Total earning A into B. 1,25,000. So they are saying 50% of that will be retained. So retained earning is 50% of 1,25,000. 50% of 1,25,000 is how much? Yes, come on, everyone. 62,500. Now many students make a mistake. They write this as an answer. This is not the final answer because company will use other sources of finance also. They want to maintain a proportion of equity, preference and debenture. So it will be only 80% of the total fund. So write down proportion of retained earning in total capital employed. Proportion of retained earning in total capital employed. This is 80% as computed above. Okay. This is computed in step 4 as per step 4. As per step 4. Proportion of retained earning in total capital employed. So what we will get now is the answer of this question. Capital investment without issuing new equity shares. Capital investment without issuing new equity shares. So what will you do? D divided by E. Come on. So on your calculator. D by E, 78,125. So 78,125 is the answer.
So to use the equity share fund 50%, that is of 80% of that value which is going to be there.
Yes. It is 80% of the total value of this project. So if you do reverse working, 80% of this is the amount. You're going to use 80% of equity shareholder fund in financing the capital investment. Remaining amount will be from preference share and debenture. 5% of it will come from debenture and 15% will come from preference share. Is it right? Now we'll come to question number 22. Write down important question number 22. One more practice on marginal cost of capital and weighted average cost of capital. Okay. So important. Please come to question number 22. In our book, have you reached question number 22? Say yes. Masco Limited wishes to raise additional finance of rupees 10 lakh for meeting its investment plans. So how much funds are required? Rupees 10 lakh. In the previous question, they had said capital investment program. Now they've given the amount of that capital investment program. How much is that? That is 10 lakh. Total is 10 lakh. It has 2,10,000 in the form of retained earning available for investment purpose. So out of 10 lakh, 2,10,000 will be funded from own funds, retained earning. So that is 2,10,000. So remaining amount they have to raise from the market. And what is the policy of this company? That debt equity mix should be in the ratio of 3:7. So for every project they will undertake, they will use debt and equity. So for this company, 3:7 is the strategy or the policy. So debt should be 3 lakh and equity should be 7 lakh. 3 lakh debt, 7 lakh equity. And out of equity also, retained earning will be 2,10,000. Retained earning will be 2,10,000 as given in the first paragraph. What about the balance 4,90,000? Balance 4,90,000 will be fresh issue of equity share. So they will have to issue equity share in the market for raising 4,90,000 rupees. What about debt? Total debt they will be 3 lakh, but the cost of debt is changing. First up to 1,80,000, it will be 10% before tax. And then after that, if you raise beyond 80 lakh, it will be 16% before tax. So debt again will have to raise 1,80,000 first and then 1,20,000. This 1,80,000 the interest rate is 10%, but when you keep on adding more and more debt, the cost of debt will rise and it will become 16%. Oh my God. Is it right? Earning per share is rupees 4. Dividend payout is 50% of earning, that is 2 rupees. Dividend is 2 rupees. Expected growth rate of dividend is 10%. Current share price is 44. So what is the purpose of giving this data? The purpose of giving this data is to find cost of equity and cost of retained earning. Dividend payout means dividend divided by earning per share. 50% of earning means 4 into 50% is 2 rupees. 2 rupees is dividend. Tax rate is 50%. Why tax rate is given? For finding the post-tax cost of debt. For finding the post-tax cost of debt. Now they are saying you are required to determine the pattern for raising the additional finance. Pattern for raising additional finance means how much will come from debt and how much will come from equity. So that is 3 lakh and 7 lakh. Determine the post-tax average cost of additional debt. This 3 lakh rupees that we are going to raise, what will be my average cost of debt after tax? Determine the cost of retained earning and cost of equity. So by using the formula D1 by P0 plus G, you can find out the cost of retained earning and cost of equity. Both will be same because there is no flotation cost. Am I right?
Yes.
And compute the overall weighted average after tax cost of additional finance, which means MCC, because they are raising additional finance. Is it easy or difficult? Easy, very, very easy. Okay, so write down first answer, write down step 1, which is our first answer. Such questions have been asked in past exams. Pattern for raising additional finance. Right in the center. Pattern for raising additional finance. Pattern for raising additional finance. Then you draw 2 branches. Which 2 branches? Debt and equity. Debt will be 3 by 10 of 10 lakh, 3 lakh. Is it right? And equity will be 7 by 10 into 10 lakh, that is 7 lakh. Again, debt will have to raise as follows. First, rupees 1,80,000 at the rate of 10% in bracket before tax, and then next rupees 1,20,000 at the rate of, right, 16% before tax. This gives you a very clear picture of what is happening. Up to this you have noted?
Yes.
And what about equity? Again, first we will write
2,10,000 retained earning.
Retained earning will be the first priority, which is given rupees 2,10,000, and then write down fresh issue of equity shares 7 lakh minus 2,10,000 is 4,90,000. This is your first answer. Any problem? What is your second question? Second, post-tax average cost of additional debt. So you are raising funds from debt 3 lakh, but they are coming at different cost. 1,80,000 you are getting at 10%. 1,20,000 you are getting at 16%. But average is not 16 plus 10 by 2. Amounts are different. Plus the impact of taxation will also be there. Is it right? So write down properly, nicely. Step 2. Step 2, write down post-tax average cost of, every time you should write a heading nicely. Post-tax average cost of additional debt. Now under that, right hand side rupees, will prepare a table. Any way you get it, answer must be same. Format is not material. Substance is important, and it should be in an understandable format. Okay, because this is a mathematical subject, everybody can present the answer in a different manner, but it should be understandable and it should give you correct answer. So first you write down point A, interest. How much interest we will pay? We'll pay first, interest will pay on 1,80,000 into 10%, correct? How much is that? 18,000. Then what about remaining interest on 1,20,000? 16%. Very good. So total interest here we are going to pay 37,200. But there is a benefit of paying interest. What is the benefit? Tax shield. So write down less tax shield. And look at the question and tell me the tax shield. 50%? Oh my God, 50%. 18,600 rupees you are going to save. So what is the interest net of tax? So you are effectively paying 18,600 only. You are effectively paying 18,600 only. Net outflow would be 18,600. You will pay 37,200 and you will save 18,600. So my net outflow will be 18,600. But to pay that amount, how much funds did you raise? How much funds did you raise? So debt amount. How much is debt amount? 3 lakh. So in short, you are paying 18,600 for raising 3 lakh rupees. Point number E, therefore, post-tax average cost of debt. Any query?
No, sir.
You will say C divided by D in 200.
6.2%.
Anybody vouching for 6.2%? 6.2%. Anybody certifying to 6.2%? What is your third question? Cost of retained earning and cost of equity. So write down step 3. Cost of equity. First we'll write one assumption. Question as a mistake. Oh, where is the mistake? Guess. Guess where is the mistake? The mistake is that they have not mentioned whether this earning per share is current year earning per share or next year earning per share. Is it right? So we will assume it is current year EPS. We'll assume it is current year. So for next year we have to increase it by the growth rate 10%. Okay. So write assumption. It is assumed that EPS given in the question is current year EPS. Current year EPS. Then write down dividend per share equal to EPS into dividend payout ratio. EPS into dividend payout ratio. How much is EPS? 4. Dividend payout ratio 50% of earning. So this is rupees 2. In bracket D0. So D1 will be D0 into 1 plus G. Is it right? 2 into 1 plus 0.10 is 2.20. P0 is 44. Growth rate is 10%. So cost of equity will be D1 by P0 plus G. $2.20 divided by 44 plus 0.10 is equal to final answer. Final answer is 15%. This is cost of equity in a query. Cost of equity is 15%. Presentation should be such that institute should understand. And then we write down step 4, cost of retained earning. Cost of retained earning. Cost of retained earnings KR is equal to KE is equal to same 15%. Is the answer 15%, right? So cost of retained earning will also be 15%. So it completes my third question, cost of retained earning and cost of equity. And the last answer, write down step 5. Overall weighted average after tax cost of additional finance. Overall weighted average after tax cost of additional finance. Source right, weight, cost, weight into cost. Amount is not required. Why amount is not required? Already weight is given in the problem, 3:7. Debt equity. Weight is given in the question. So 3 by 10, 7 by 10. Don't write 3 by 7. 3 is debt, 7 is equity. So 3 plus 7 is 10. And what is the cost of debt? Average cost we have computed 6.2%. And cost of equity, which will include both retained earning also, 15%. Now you tell me the answer. 6.2 into 3 by 10. 4 point? 1.86. Sorry, 1.86. Okay, next.
12.30 मतलब 10.5%.
10.5.
Total is 12.5.
12.36%. So WACC equal to 12.36%. Is it right? Come to question number 25. Read yourself. Read question 25 yourself. After reading, what do you observe? Almost same as 22, except the debt equity ratio. All remaining details are same. So kindly do it as homework. It was May 2018 RTB. Okay, so tick mark 25 as homework. Follow the format I have already used. Now we'll take question 34 from May 19 exam. Question number 34 from May 19 exam. All questions that I am doing are important. Alpha Limited has furnished the following information. EPS 4, dividend payout ratio 25%, market price 50, rate of tax 30%, growth rate 10%. Company wants to raise an additional capital of rupees 10 lakh, including debt of rupees 4 lakh. Cost of debt before tax is 10%, up to 2 lakh, and 15% beyond that. Compute the after tax cost of equity and debt, and also calculate the weighted average cost of capital. Is it right? If you look at the question, it is similar to the previous problem. But what is the difference? Retained earning is not mentioned separately. So how much is the total funds to be raised? 10 lakh. How much is debt? 4 lakh. So what will be equity? 6 lakh. Equity will be 6 lakh. So first we'll find out the cost of debt, then we'll find out the cost of equity, then we'll find out the weighted average cost of capital. Is it right? Say yes. Right. This is an exam question for 5 marks. May 19 exam. Can be repeated for your exam also. Are you enjoying or not?
Yes, sir.
Calculation of post-tax cost of debt. They have just simplified the previous problem. Okay. So this is another format in which this question can be asked. Write down first interest. Point number A, interest. Under that, on rupees 2 lakh, they are going to raise first 2 lakh at what rate? 10%. So they will have to pay 20,000. On next rupees 2 lakh,
15%.
at the rate 15%. So that will be 30,000. So total interest 50,000. Point B, less tax shield at the rate of, what is the tax rate? 30%. So 30% you will save in the form of tax, 15,000. So what is interest net of tax? So what you actually pay from your pocket is 35,000. And what is the amount of debt? 4 lakh. In order to raise 4 lakh, you are paying 35,000 rupees net of tax. So therefore, post tax cost of debt, apply common sense, you are paying 35,000 for 4 lakh rupees. C by D into 100. Student will answer 8.75%. Is it right? Step 2, right? Cost of equity. Cost of equity, KE. Note, it is assumed that EPS given in the question is current year EPS. They are not mentioning in the problem. Student can get different answer. So now write down DPS is equal to EPS into dividend payout ratio. EPS is 4, DP ratio 25%. So that is D0, you can say D0 equal to 1. D1 will be D0 into 1 plus G. What is the growth rate in the problem? 10%. So that D1 will be equal to how much? 1.1. So cost of equity will be D1 by P0 plus G. D1 by P0 plus G. 1.1. P0 is how much? 50 rupees. Growth rate is how much? 0.10. 12 point. 1 second. 12.2% is right. Now one student wants to ask a query. Come on.
So that D naught is 1, that is 25% of 4. We are assuming that because we have given the growth rate, right? If growth rate is not given, we can assume it as.
If growth rate is not given, then it will not affect your answer because then dividend will remain constant only. Oh my God. So you have to write the assumption. So now the last step is WACC. Up to this, any other doubt?
No, sir.
Done. Step 3, WACC. Actually it is MCC, but they have used the term WACC in the problem. Source, amount, weight, specific cost, weight into cost. Source, write down debt equity. Debt equity. Debt is 4 lakh. Total amount they want to raise 10 lakh. So what is equity? 6 lakh. Understandable. Weight will be 0.4 and 0.6. 4 lakh by 10 lakh. 6 lakh by 10 lakh. What was the specific cost of debt? Is it 8.75%? 8.75%. And equity was 12.2%. 12.2%. 0.4 into 8.75. 0.6 into 12.2.
7.32.
10.82%. Is it right? Come to one question number 26. One more variety. Question number 26. Number 18 RTB. You will prepare a lot of things, but institute will always give you surprise. Variety of question have to be practiced. Okay, there is no shortcut. Messrs. Navya Corporation has a capital structure of 40% debt and 60% equity. The company is presently considering several investment proposals costing less than rupees 20 lakh. So they are considering different projects. That means these are the project cost. The corporation always raises the required funds without disturbing its present debt equity ratio. Underline, it means whenever they will raise funds, they will maintain this ratio. Some company follow this policy of using a certain percentage of debt and a certain percentage of equity. This company follows 40-60 ratio. Cost of raising debt and equity are as follows. If you raise up to rupees 2 lakh, cost of debt will be 10, equity will be 12%, but for 2 lakh to 5 lakh, 11% cost of debt, 13% cost of equity. For between 5 to 10 lakh, cost of debt is 12%, cost of equity is 14%, and 10 to 20 lakh, 13 and 14.5%. So depending upon what is the project cost, accordingly its weighted average cost of capital will vary. Is it right? Assuming tax rate is 50%. Why this is given? To calculate the cost of post-tax cost of debt. Question has a mistake. They have not mentioned very clearly whether it is pre-tax cost of debt or post-tax cost of debt. So what assumption we will write? Assumption right. Assumption dash. It begin with assumption. It is assumed that cost of debt given in the question is pre-tax cost of debt. Cost of tax given in the question is pre-tax cost of debt. Then right below, post-tax cost of debt is equal to I into 1 minus T. Okay. Now read question further. Calculate. First question is cost of capital of two project X and Y whose funds requirements are 6.5 lakh. So 6.5 lakh means it will fall in the third slab. So it belongs to this category of project between 5 to 10 lakh. Is it right? So you have to find out the weighted average cost of capital if the funds raised are between 5 to 10 lakh. And second is 14 lakh. 14 lakh means it will fall in the fourth block, 14 lakh, 10 to 20. second question is, if the project is expected to give after tax return of 10%. So reverse question now. Suppose you invest in a project and that project will give you an after tax return of 10%. The project will give you an after tax return of 10%. Determine under what conditions it would be acceptable. So when will you accept a project which is expected to give a return of 10%? When will you accept a project which is expected to give a return of 10%? So suppose you are a businessman. If a project is expected to give a return of 10%, when will you accept it? When will you accept a project which gives you a return of 10%? When will you accept a project which is expected to give an after tax return of 10% based on this question, not general answer. So your answer will be, if the cost of capital is less than 10%, then we'll accept that project, because you should accept a project only when the return is more than cost of capital. Is it right? So weighted average cost of capital of that project should be below 10%, then it will be acceptable. No calculation required. General knowledge question, even a street vendor can answer. Is it right? So first what I'll do, first I will calculate cost of project for different level of financing, for different slabs. Okay. Have you written that note on assumption?
Yes, sir.
Okay, start. So first write down step 1. Step 1, calculation of WACC for different sizes of projects. Calculation of WACC for different sizes of projects. Yes, now student wants to ask a query in the classroom.
If a businessman wants to earn 10 rupees.
If a businessman is not 1-to-1, he is getting a return of 10%.
Okay, he's getting the return of.
He is expected to earn a return of 10%.
He's getting 10 rupees on 100.
10 rupees on 100 rupees investment. Wonderful.
So to raise that investment, he should apply 8 or below 10.
The cost should be less than 10. Suppose this bank gives you dividend interest of 10 rupees.
Yes.
I am willing to lend you money. So you can borrow from me and invest in that bank. But if the bank is giving you 10 rupees interest, so you will borrow from me and invest only when I will give you funds below 10% interest rate.
Yes.
So that is my cost of capital when you raise funds from investor. So write down a table. This time the table format is different. Project cost. First column is copied from question. Then you write down weight of debt. WD means weight of debt. And KD means cost of debt. Weight of equity. Cost of equity. And WACC is equal to weight of debt into cost of debt plus weight of equity into cost of equity. So instead of solving by making 4 tables, we will solve in one table all 4 answers. It's like asking you 4 questions, okay? It is like solving 4 questions in one table. So first you draw this format. Project cost, weight of debt, cost of debt, weight of equity, cost of equity, and WACC equal to WD into KD plus WE into KE. Are you happy? Okay, so write. Just copy this from the question book, up to rupees 2 lakh. Same line, copy. Up to rupees 2 lakh. Weight of debt, How much is weight of debt? Every time they raise funds, they maintain the ratio of debt and equity, debt 40, equity 60. Is it right? So this will always be 0.4 and weight of equity will always be 0.6. Stop. What will be cost of debt? It is 10 into 1 minus 0.5. Tax rate is 50%. So 5%. After tax cost of debt will be interest rate into 1 minus tax rate. Okay. Formula already written. Cost of equity is 12%. Cost of equity we don't multiply by 1 minus t. I hope you know that. Okay. So now how will you get the answer? You have to tell me. I will help you with 1.4 into 5 and plus 0.6 into 12. So 0.4 into 5 is how much? 2 and 0.6 into 12 is 7.2. So give me the answer. Is it 9.2%? 9.2%. Okay, one line blank. Now write down above rupees 2 lakhs and up to rupees 5 lakhs. So this will always be 0.4 and this will always be 0.6. Now 11% is the cost of debt in the problem pre-tax. So post-tax will be 5.5. Cost of equity will remain 13. Post-tax will become half because tax rate is 50%. So please reply now. 0.4 into 5.5 plus 0.6 into 13. So total is 10. Total is 10%. Okay, one line blank. Write above rupees 5 lakhs and up to rupees 10 lakh and up to rupees 10 lakhs. So this will be 0.4, this will be this is a new type of question, but it was asked in your RTP. I can't take it lightly. Okay, if it is asked in the exam, then most of you will be clean bold. Cost of equity is 14%. Yes, come on, try. Give me the correct answer. 0.4 into 6 and plus 0.6 into 14. 10.8%. Very good, wonderful. Then write one line blank. First keep one line blank. Above rupees 10 lakh. Keep one line blank. Above rupees 10 lakh and up to rupees 20 lakh. Write properly. If you want full, write full. If you want half, write half. If you don't want anything, don't write. Is it right? So what is the cost of equity last? 14.5%. Anybody wants to answer? What is the final answer? 11.3%. Wonderful. Now wait, our answer is not over. This will help you to answer the question number 1. Question number 1 was calculate the cost of capital of two projects X and Y whose funds requirement are 6.5 lakh. So 6.5 lakh means it will fall in this third category of projects. So what is the cost of capital of project X? 10.8. 14 lakh means it will fall in the fourth category of projects whose requirement of fund is between 10 to 20 lakh. So what is the cost of capital of project Y? 11.3%. So to write a note. Step 2. Cost of capital of project X and project Y. So first column write down project, second column funds required, and third column cost of capital. So project name is X. funds required is 6.5 lakhs rupees. So it will be third category of project. So that is 10.8%. Project Y, funds required rupees 14 lakhs. In your exam, they can change the amount. Okay, so don't remember answer. Understand. 14 lakh means it is between 10 to 20. And then you will go to the last column and check what is the cost. 11.3%. So this is your first answer. Any query on this? Now the last question is, if the project is expected to give after tax return of 10%, determine under what conditions it would be acceptable. So write down step 3. If the project is expected to give after tax return of 10%, it would be acceptable if the cost of capital is less than 10%. If the cost of capital is less than 10%. That is, in the given example, now I am going to previous page. Now you see on the screen, if the cost of the project is up to 2 lakh, it is 9.2 acceptable. 2 to 5 lakh, it is 10%. Even that is acceptable. Okay. But if the cost of project is more than 5 lakh, then it exceeds 10% and it is not acceptable. So first and second category of projects are acceptable if the expected return is 10%. So write down this line completely. That is, in our example, if the project cost is less than or equal to rupees 5 lakhs. Project cost is less than or equal to rupees 5 lakh. 5 lakh in our example. You don't have to by heart 5 lakh. In your exam, they will change the figures. So up to 5 lakh, my cost of capital is less than or equal to 10%. So project cost up to 5 lakh will be acceptable if the after tax return is 10%. Okay. So this answer is over. Now come to question 26. Read yourself. So 26 we have just now done. So you have solved different varieties of problem. Then there is a theory question number 30, which says that discuss the dividend price approach to estimate the cost of equity capital. So a theory question was asked for 5 marks in MTP. Dividend price approach, already printed in our notes, and today I had given you formula also. If the dividend is expected to remain constant, then it is dividend upon price. If dividend is expected to grow, D1 upon P0 plus G. So this approach assumes that price of the share is the present value of future dividend. Is it right? You understood now? So this wonderful chapter is over. If some questions are remaining, then you will try. Okay, you will try all the questions. You will practice all the questions in our book. Questions have been taken from your study material, RTP, MTP and exam. So Thank you for this chapter. Yes, today we are going to revise capital structure chapter.
Yes, sir.
Financial decision capital structure chapter. So, capital structure has 4 theories in our syllabus. Which 4 theories?
Net income approach,
Net income approach,
then traditional approach,
net operating income approach, traditional approach, Modigliani Miller approach. So you write down a small summary of this chapter. Capital structure theories. Capital structure theory. So this will summarize the whole chapter. Serial number, particulars, right? Net income approach, net operating income approach, traditional approach, net income approach. Also write down Modigliani and Miller approach, because these two approaches are similar. Modigliani and Miller approach without tax. Draw one full page. If you have the scale, it will be easy for you to understand. First, what is the cost of debt, KD? Cost of debt is constant. Capital structure theories are trying to answer the question whether by changing the capital structure value of the firm will change. So in the process they are making some assumptions. So as per NI approach, KD will remain constant. As per NOI approach or M&M approach, KD remains constant. As per traditional approach, KD remains constant up to a certain level. Up to a certain level. Thereafter, it increases. Thereafter, it increases. So, under traditional approach, cost of debt will also start rising beyond a certain point. Second, write down cost of equity, KE. Cost of equity, write down, remains constant under net income approach, but under net operating income approach increases with the use of more debt. With the use of more debt. In traditional approach, initially K is constant, but starts increasing beyond a certain level of debt. So cost of equity remains constant, but beyond a certain level it starts increasing. So in phase 1 of capital structure, when debt is low, K is constant. Phase 2, when you use more debt, it starts increasing. And phase 3 also, it keeps on increasing, increases at a faster pace, increases at a faster pace. It will increase, but increase at a faster pace now. So point number 3, write down: risk perception of investor. Risk perception of investor. What investor thinks about the risk of the firm. So you will say risk perception of investor in net income approach does not change. Risk perception of the investor does not change. Net operating income approach, equity investors think the risk has increased. Equity investor thinks that the risk has increased with the use of more debt. Equity investor think that the risk has increased with the use of more debt. Is it right? And in the traditional approach, write down: increases for both debt and equity investors. Increases for both debt and equity investors. Increases for both debt and equity investors. So this is third point. Have you noted it down? It's not over. We have to write few more points. Keep writing. At one place you will have the entire chapter in one page. Net income approach, I'll just write heading again. Net operating income or M&M approach, traditional approach. Draw the lines. Okay, follow me. Point number 4, write down: what happens to KO or WACC in net income approach decreases with the use of more debt. So if you use more debt, WACC will decrease. What happens to WACC under NY or M&M approach? Constant. Under NY approach, WACC remains constant. Traditional approach, phase 1 decreases. Phase 1 low debt. Phase 2 means moderate debt is constant when the proportion of debt is moderate. And phase 3, when debt is very high, then it starts increasing. It starts increasing. Is it right? Point number 5, value of the firm. So what happens to the value of the firm? Under net income approach, increases with the use of more debt. Point number 4 and 5 are same actually. 4 is saying KO decreases, which means value of the firm increases. Under NOI approach and MM approach without tax, when there is no tax, value of the firm remains constant. And what happens in traditional phase? Phase 1, value of the firm will increase. Exactly reverse of the fourth number point, value of the firm remains constant in phase 2, and in phase 3 the value of the firm will start decreasing. If you use more debt, KO will rise. If KO will rise, value of the firm will fall. Is it right? Point 6. Formula for value of firm. In net income approach, value of firm will be equal to, you first find value of equity and plus value of debt. Value of firm is equal to value of equity plus value of debt. In NOI approach, value of firm is equal to EBIT upon KO. EBIT upon KO. And in traditional approach also, usually will follow this method. First we will find value of equity and we will add value of debt. Got it? Then how do you get value of equity? In net income approach, usually what we do, we take earning before tax divided by cost of equity to get the value of equity. In case of NOI or M&M approach, value of equity is equal to balancing figure is value of firm minus value of debt. And in traditional approach also, it is EBT upon KE. So usually these are the steps we follow. And how do you get value of debt? Value of debt will be interest upon cost of debt. Interest upon cost of debt. Usually given in the problem only. Cost value of debt is usually given in the problem. If not given, interest upon cost of debt. If not given, you can try yourself. Okay, done. Are you writing nicely? So one day before the exam you can use it for revision purpose. Point number 9, write down. Does capital structure matter does capital structure matter, that is influences value of firm. Does capital structure influences the value of firm? So, the answer as per net income approach is yes. Capital structure influences the value of the firm. In NOI approach, Modigliani-Miller approach, if there are no taxes, then capital structure does not influence the value of the firm. And under traditional approach, the answer is yes. Capital structure influences the value of the firm. 10th point, write down, what is the optimum capital structure? What is the optimum capital structure? So, in the under net income approach, the answer is maximum use of debt. Maximum use of debt. Okay. If possible, use 100% debt. If possible, use 100% or whatever maximum debt is possible, you will use to maximize the value of the firm. Here, no capital structure is optimum. Or every capital structure is optimum. Or every capital structure is optimum. In traditional approach, optimum capital structure is phase 2 capital structure. Is phase 2 capital structure. That means they should stop at phase 2. Is it right? Point number A, cost of equity. How to calculate cost of equity? So, cost of equity equal to EBT upon value of equity. Here EBT upon value of equity or K is equal to KO plus KO minus KD into debt upon equity. This is Modigliani-Miller formula. In last column also same thing, EBT upon value of equity. And how will you calculate overall cost of capital? KO. So, KO will be equal to EBIT upon value of firm under net income approach. We are revising the chapter capital structure. Okay. Here also same, or you can also find out KO by weight of debt into cost of debt plus weight of equity into, same formula applicable in all approaches. Same formula applicable in all approaches. Either you can use weighted average cost of capital or EBIT upon value of the firm. Have you written 12 points? Is it a good summary of this chapter? One more point. 13 number point, write down diagram. How will the diagram look like? Net income approach, KD is constant, K is constant, KO will fall. Net income approach. Net operating income approach, KD is constant, K will rise with the use of more debt. On the x axis we have debt equity and on y axis we have cost. KO will remain constant here. Do you remember anything like this? Have you studied like this?
Yes.
And in traditional approach, so there are 3 phases. Phase 1, phase 2, phase 3. You have debt equity ratio here. Okay. So debt will remain constant, KD. Phase 1, K will also remain constant. So KO will fall. This will look like net income approach, first phase. Okay. Phase 2, KD is still constant. K will rise. KO will become constant. Phase 3, KD will rise. K will rise. So this will also start rising. So phase 2 is the optimum capital structure. Phase 2 is the optimum capital structure. Is it right? So close this chart now. Now we'll write next heading, Modigliani and Miller approach in bracket and net operating income approach with tax. With tax. So here first we'll find value of unlevered firm, VU is equal to EBIT upon KO or KE, right? KO or KE will be same for unlevered firm. Unlevered firm does not use debt, 100% equity firm. Then what you will do? You will find value of levered firm, that is VL, will be equal to value of unlevered firm plus debt into tax rate, that is the present value of tax shield on interest. Okay. Where debt into tax rate is present value of tax shield on interest. Present value of tax shield on interest. Third, write down. Then they will ask you value of equity of unlevered firm. Sorry, levered firm. Value of equity of levered firm. In case of unlevered firm, value of equity and value of firm are equal. So, value of equity of levered firm will be value of firm minus value of debt. Value of firm minus is value of equity of levered firm. What about value of equity of unlevered firm? Same. Equity and firm has same value if there is no debt. KO and KE are equal. Value of firm and value of equity are equal for unlevered firm. Up to this you have noted. Point 4, write down. Cost of equity of levered firm will be earning after tax upon value of equity. Earning after tax upon value of equity. Then write down overall cost of capital is equal to EBIT into 1 minus T upon value of firm. Right? Or KO is equal to WD into KD plus WE, weight of equity, into cost of equity, where cost of debt will be interest into 1 minus tax rate. Interest into 1 minus tax rate. Interest into 1 minus tax rate. Note, for unlevered firm, point 1, KO is equal to KE, value of firm is equal to value of equity. Right? Then we have seen some more formulae. So these are the formulae relating to capital structure theories. Next formula is for financial break-even point. Write down next heading. Financial break-even point. Financial break-even point is that level of EBIT at which EPS is equal to 0. That level of EBIT at which EPS is equal to 0. And the formula is financial break-even point equal to, who will give me the formula? Interest plus preference dividend divided by 1 minus tax rate. you need to earn so much EBIT so that you can pay interest and preference dividend. Okay. So that they will ask you in some question. Next we have seen one more formula, EPS in difference point. EPS in difference point. So write on next heading, EPS in difference point. 1 second. First you note down this much. Write in good handwriting. One day you have to read also. Write down EPS in difference point. First, what is EPS in difference point? It is that level of EBIT at which EPS under two financing plans are equal. It is that level of EBIT at which EPS under two financing plans are equal. It is also called EPS equivalency point. EPS equivalency point. So how do we solve? We'll write an equation and solve. EBIT minus interest into 1 minus tax rate minus preference dividend 1, even interest 1, that is EPS under first plan, divide by number of share N1. Second plan, EBIT minus interest 2 into 1 minus tax rate minus PD2 divide by N2. N1, N2 means number of equity share. This means number of equity shares. Already we have covered in our regular lectures number of equity shares under plan 2.
Yes, sir.
Now in some question preference dividend may not be there, write 0. In some question interest may not be there, write 0. So what you have to do, according to question, you have to change the formula. If a formula has only equity, then EBIT into 1 minus T. If it has equity plus debt, EBIT minus interest into 1 minus T. If it has all the three, equity, debt, preference, EBIT minus interest into 1 minus T minus preference dividend. Is it right? What you have to do after writing this, solve the equation and find EBIT. The diagram for this will be this is plan 1, this is plan 2, this is EBIT on x axis, EPS on y axis. So this is your EPS in difference point, where EPS under plan 1 and plan 2 are equal. Okay. Below this point Plan 1 will have higher EPS above this point. In our example, Plan 2 will have higher EPS. So when they ask you to write a theory question, it is better to draw the diagram. Is it right? Now we'll solve some questions. So you can just revise it a day before the exam. All the formula we have covered in this. So please come to question number. Check what is this question number, November 2022 exam for 4 marks. Question number 45. November 22 exam for 4 marks. Are you ready? The following are the cost and values of the firm A and B according to traditional approach. According to which approach? Traditional approach. Traditional approach means the overall cost of capital and value of the firm can change by using a proper capital structure in phase 2. That was traditional approach. So what data they have given, accordingly we have to solve. Total value of the firm V is given 50,000, 60,000. Market value of debt D is given in rupees. Question number 45 in the book, 0 and 30,000. Market value of equity. Now how they have got market value of equity? Value of the firm minus value of debt. 50,000 and 30,000. Even if this was not given, you could have calculated this, yes or no, but your institute is very kind. Now they have given expected net operating income. Net operating income means EBIT. Net operating income means EBIT is 5,000 rupees. Cost of debt in rupees means interest. So what it means is basically interest. If it is given in percentage, then it is different. It is rate of interest. If it is given in amount, it is interest. So 0 because there is no debt in the first column, and 1800 they have calculated themselves. Now next is net income. Net income means EBIT minus interest or EBT. So they have, see, they are so kind. They have done the calculation for you. 5,000 minus 0 is 5,000. 5,000 minus 1800 is equal to 3,200. Now they have written cost of equity K is equal to net income upon V. What is the mistake here? I have written a mistake here. Cost of equity is net income upon value of equity. So it should be NI upon E. Should be NI upon E. But what they have written? NI upon V. So that's a wrong formula, wrong use of letter here. Anyway, you can just try, is it matching or not? 5,000, no, it is matching. Calculation is matching, formula is wrong. 5,000 divided by 50,000, how much? 10%. Then take on your calculator 3,200 divided by this 30,000. 10.66. So they have rounded off in 2 digits, 10.7%. Okay. So anyway, don't bother. Only this letter V should have been E. Okay. Let us go ahead. Most of the calculation they have done. Compute the equilibrium value for firm A and firm B in accordance with approach. Equilibrium value means market value of the two firms you have to find out. You have to find out the market value of the two firms. Okay. Assuming that taxes do not exist. So this is M&M approach without taxation. Enjoy, no taxation. and the equilibrium value of KE is 9.09%. Compute the value of equity and cost of equity for both the firms. Again, one mistake. They are saying equilibrium value of K is 9.09%. Then why they are asking calculate the cost of equity for both the firms? So it is appearing that this K should have been KO. That means the overall cost of capital is KO. Then we can do reverse working and find out first the value of firm minus value of equity. Then you will be able to compute the cost of equity. Is it right? So we will write few notes about this question. First is this is one small mistake here. Second, this should have been KO, because if it is KE here, then there is no need to ask this question. Find out the cost of equity for both the firms. The two firms can have same KO. The two firms can have same KO, but they cannot have same KE because firm A is not using debt and firm B is using debt. So KE of firm B would be higher than firm A because firm B is a levered firm. So one is unlevered firm, one is levered firm. And since there is no taxation, the calculation would be very simple. So write down some notes. Interested candidates will write some note. In the question, it is given right, so that you will understand also. Writing makes you more understandable. Okay, if you only just keep watching, it becomes like some kirtan or bhajan is happening here, or you have come into satsang and nothing happens after you go home. You are back to the same person, but you have to participate. So in the given question, K is equal to Ni by V, it should be Ni by E. It should be Ni by E. Do you agree? Second note, write down. It is given that equilibrium value of K is equal to 9.09%. It is given equilibrium value of K is equal to 9.09%. It should be KO. It should be KO. Otherwise, there is no need to. Ask cost of equity. In part 2 of the question, there is no need to ask cost of equity in part 2 of the question. Third line, write down. Under M&M approach, write little fast. Where taxes do not exist, the value of the two firms are equal. And overall cost of capital is also equal. The value of the two firms are equal and overall cost of capital is also equal. KO are equal, value of the two firms are equal if they belong to same line of business. So now you write down next line. where we will solve, they have asked to find out the value of the equity, cost of equity for both the firms, right? Under which approach? M&M approach. The given data is as per traditional approach. The given data is as per traditional approach. But you have to solve the same problem under M&M approach. That is the beauty of this question. Given data is for traditional approach, but you have to assume now M&M approach and see what will happen. So please write a very good question, subject to some minor error in the drafting of the question. Calculation of value of the firm, value of equity and cost of equity of both the firms under M&M approach. Right, under M&M approach. Under M&M approach. Are you ready? Say yes, we are ready. Yes, we are ready. So first you start with EBIT. Look at the question. EBIT of both the firms. In your question book, come on, EBIT of both the firms. How much? 5,000 each. 5,000. Point number B, write down cost of capital. Cost of capital. How much is cost of capital? KO. We have written a note that this 9.09% which they have given to us, we will treat it as a KO, not KE. So cost of capital is 9.09%. We have written a note also that under MM approach, both the firms will have same value and same KO if there is no taxation. Point number C. Value of the firm. Yes, come on, EBIT and cost of capital is given to you. So can you please tell me what will be the value of the firm? Multiply or divide? A by B or A into B? A by B. Sorry. A by B. Take on your Chinese calculator. 5,000 divided by 9.09%. So both the firms value will be same, 55,006. Are you getting? Now what should we do to get the value of equity? We should deduct the value of debt. Deduct the value of debt. Deduct the value of debt, 0 and 30,000. 0 and 30,000. Okay. Then write down value of equity, C minus D. Come on. Who will reply? Value of equity under M&M approach. 55,006 and 25,006. Are you getting? What is the next point we will write? Interest. How much is the interest given to you? Interest is given in the problem. Please search. 0 and 1800. So then write down EBT, A minus F. EBT is A minus F. EBIT is 5,000. Interest is first column 0. So EBT will be 5,000 and 5,000 minus 1800. 3,200, right? 3,200. 3,200 is right. $3,200 is right. So now this answer is over value of equity. How will you get cost of equity? EBT divide by value of equity. So write down cost of equity equal to, one more time write down the formula, EBT upon value of equity. EBT upon value of equity 9.09%. Check, you will get the same result because there is no debt. And second column 12.8%. 12.8% is right. Write down below. Alternatively, for firm B, KE can be calculated as follows. Alternatively, for firm B, KE can be calculated as follows. Do you remember the formula for cost of equity as per M&M? So write down as per M&M, K is equal to KO plus KO minus KD into debt upon equity. So I'll give you the value, you will solve, keep the firm B in front of you in your answer. KO 9.09. What is the cost of debt in this problem? Cost of debt in percentage. How much is the how much is the rate of interest in this problem? Can you just look at the question and give me the rate of interest? Where is the rate of interest? Where is the rate of interest? You are a student of finance. How much is the interest amount given in the problem? How much is the value of debt given in the problem? 30,000. 6%. So this you will write later as a working note. So first you write down 9.09 plus 9.09 minus 6 into 30,000 divided by 25,006. So that comes to 12.8%. Is it tallying with your tabular format answer? Right. So both way you can solve cost of equity of a levered firm. Either you can take EBT upon value of equity, or you can apply the formula. You will get same answer. And the rate of interest in the question is 1800 rupees the amount of interest and 30,000 is the value of debt. So are we getting 6%? Yes. Now we'll come to one question number 7 in your book. Requesting you to please come to question number 7. Find question number 7 and come wherever it is. Find question number 7 and come. In your book, a very comprehensive book given to you. We will take all important questions today so that your chapter will get revised. And few questions which if we are not able to take in the class, similar question you can do as homework also. So are you there? Question number 7, are you there? See the importance of this question first. Study material, October 2021 MTP 5 marks, April 2020 MTP for 5 marks. Following data is available in respect of two companies having same business risk. If they have same business risk and if there is no taxation, the values will also be same, KO will also be same. Capital employed is 2 lakh, EBIT is 30,000 and cost of equity is 12.5%. Now they are saying these are the two firms, levered firm, unlevered firm. Debt 1 lakh, equity 1 lakh. In unlevered firm 2 lakh. And debt borrowing rate is 10% given here. Investor is holding 15% share in levered company. Calculate the increase in annual earning of the investor if he switches his holding from levered firm to unlevered firm. If he switches his holding from levered firm to unlevered firm. Okay. So right, first we will find out the value of the firm. So this is a question under which approach? Modigliani and Miller approach. Question is not complete. They should have mentioned here under M&M approach. Right. As per M&M approach, if the two firms are similar in all aspects except their capital structure, their values must be same. If their values are not same, then investor will substitute corporate leverage for personal leverage. They can borrow at the same rate at which the company borrows, and they will borrow in the same ratio and which the company borrows, and therefore by buying sale of undervalued company and selling shares of overvalued company, they will be able to make extra gain, and that is what we have to prove here. If one person does it, more people will do the same exercise. When more and more people make arbitrage profit, the value of the two firms will be equal. The one which is overvalued, its price will fall. The one which is undervalued, its price will rise. So now you first write down calculation of value of two firms. Step 1. Calculation of, this is another typical exam question where you have to apply the arbitrage principle and show how will you shift from overvalued company to undervalued company and how much additional profit you are going to earn. So which are these two firms? Levered firm, unlevered firm. We will take today some of the most important and likely questions for exam purpose. Okay. So write down first point A, write down EBIT. Check EBIT in the first paragraph. Both firms have rupees 30,000 EBIT. Keep writing along with me or you will be left behind. Less interest. First company has interest 1 lakh into 10%. Question in front of you. Today you will revise the whole chapter again. 10,000 in the first column. Point C, write down EBT 20,000, 30,000. Point number D, cost of equity. Now this question has a small area of doubt. Cost of equity they have given only once, 12.5%. They have not clarified is it for levered firm or is it for unlevered firm. So what we will do, we will assume it is for both. On your own you can't assume anything, is it right? So better you take 12.5% for both. So what will be the next line? Value of equity. Value of equity is equal to EBT upon KE. EBT upon KE if there is no tax. Please solve. 20,000 divided by 12.5% is 1,60,000. 30,000 divided by 12.5% is 2,40,000. Point number F, value of debt. Value of debt in levered company is 1 lakh. Unlevered company 0. Point number G, write down value of firm. Value of firm is E plus F. 2,60,000. 2,40,000. So I'll just write a remark here. Which is overvalued firm? Levered firm, overvalued. Which is undervalued firm? Unlevered. So under Modiglian and Miller approach, first we have to identify which is the overvalued firm. You will sell shares of overvalued firm and buy shares of unlevered firm and also borrow money. Is it right? and also borrow money. So right in the question they have given you one small hint. An investor is holding 15% share in levered company. Calculate increase in annual earning if the investor switches his holding from levered firm to unlevered firm. Okay. So write down step number 2. The investor, step 2, write down the investor will sell. The investor will sell the investor will sell 15% shares in levered company. So what is the amount realized? How much cash he will get by selling? 15% into come on, this is the value of equity of levered firm 1,60,000. Suppose you are holding 15% stake in this company, so you can sell it for 15% of 1,60,000. Anybody, how much is that? Is it 24,000? 24,000. Step 3. The investor will borrow. The investor will borrow proportionate amount. Investor will borrow proportionate amount to maintain the level of risk. The investor will borrow proportionate amount to maintain the level of risk. So now you understand, this is the difficult part of this chapter. Equity is 1,60,000 against which we have 24,000. Firm has a debt of 1 lakh. So how much amount will the investor borrow so that investor will have the same debt equity ratio? How much amount investor will borrow? Anybody? Amount to be borrowed. Yes, you are not replying. We have already done in the regular batch similar questions, or you must have done. Amount to be borrowed is equal to. So I will tell you once again. In case of company, equity is 1,60,000, loan is 1 lakh. Equity versus loan. So in case of investor, his own fund is 24,000. So how much should be the loan in his account? Proportionate amount. Or anybody? Yes, please reply. If you don't reply, I will not teach only. How will I go ahead if you can't solve arithmetic? Then amount to be borrowed is equal to 15,000. Either you write this if this is understandable, or very simply just take 15% he has equity, so he will take 15% of debt. That is 15% of same percentage multiplied by amount of debt 1 lakh, so 15,000. At what rate he will borrow? At the same rate at which the firm has borrowed, at the rate 10% per annum interest. He will borrow in his personal capacity. He will maintain the same debt equity ratio in his individual capacity which the firm is maintaining, and he will borrow at the same rate, because if he borrows at a higher rate he will not be able to earn additional profit, and if he does not maintain in that same proportion, again he may not be able to earn the additional profit. So now the question was, how much would be the additional income. Step number 4, write down first. Step number 4, total amount available for investment. Total amount available for investment in unlevered form. Total amount available for investment in unlevered form will be own fund 24,000, borrowed fund 15,000 equal to rupees 39,000. So he will put 39,000 in unlevered form. He has his own money 24,000. He borrowed 15,000. So now he will invest 39,000 in unlevered company. Last step 5, write down. Calculation of increase in annual earning. Please try calculation of increase in annual earning. Earlier he was holding shares in levered company. Now he is holding shares in unlevered firm. First chance to you. You must have done this question before. How much additional earning he will have by switching from levered firm to unlevered firm? First chance to whom? To the student. Why? Because he is intelligent and we are revising. So you should also get chance. So let us write down first EBT of the firm. How much is EBT as per step 1? As per step 1, 20,000 and? So this is the earning of the company. EBT of the firms. And then you write point B, net income of the investor. How much investor will earn in these two companies? So first point A, dividend income. Investor is holding 15% in the levered firm. So if he remains in levered firm, he will enjoy 15% of 20,000. That is 3,000. So earlier he was getting a dividend income of 3,000. How much he will get now? Now he has purchased, on the screen, pay attention, 39,000 rupees divided by 2,40,000. So his stake in the company is not 15%. It is 39,000 out of 2,40,000. 39,000 total valuation is 2,40,000 into the share in the into the earning 30,000. So he will get 4,875. But in unlevered firm, to invest the money in unlevered firm, he has borrowed money. So what I'll do? Less interest on borrowing. Less interest on borrowing. How much amount he has borrowed?
15,000.
At what rate he has borrowed? 10%. So in the second firm, he has to pay 1,500 rupees interest. So what is the net earning? Yeah, net income. Small a minus small b. Here it is 3,000. It is 3,375. Very good. So earlier he was earning 3,000 by switching from one company to another company by borrowing some money in certain ratio and at certain rate, is getting 3,375 more. Therefore, your question was increase in annual earnings. Write down. Therefore, according to question, write the heading. How much additional earning he will have? 3,375 minus 3,000. 375. 375. Is it right? This answer is over. Any query on this question? This is second type of question where they will ask you to show the shift from one form to another form. Now we'll go to one question number 23. Please come to question number 23. In your book you will find question number 23. Very important question. This question was asked in May 18 May 18 RTP, and also write it is a past exam question. Past exam question. They have asked in past before 2018 under old syllabus. Okay. Company P and Q are identical in all respect, including risk factor, except for debt equity. So their debt equity ratio is different. Company P have issued 10% debenture of 18 lakh, while company Q unlevered, means there is no debt. Q is unlevered, P is levered. Both the companies earn 20% before interest and tax on their total asset of 30 lakh. So my question to intelligent student is, what is the EBIT of these two companies? Both companies earn 20% before interest and tax, means EBIT, on their total asset of rupees 30 lakh. 6 lakh, 20% into 30 lakh. 6 lakh is the EBIT. So this time EBIT is not directly given to you, but you will have to do some efforts, calculation. So EBIT is 6 lakh. Assume tax rate is 50%. So now we are solving a question with taxation. First two question I solved without taxation. And capitalization rate of 15% from an all equity company. It means KE of unlevered firm is equal to 15%, which is also equal to KO of unlevered firm, which is also equal to K of unlevered firm. Is it right? Then compute the value of the firm P and Q using net income approach and using net operating income approach. So when there is a taxation, how do we solve? Under net income approach and under net operating income approach. So right, first we will solve under net income approach. Same method we have already used. Write down calculation of value of two companies. Step 1, or heading, write down first heading, calculation of value of two companies under net income approach. So this question was asked in exam some years ago for 6 marks. And this is when you have taxation, in bracket with taxation. With taxation, net income approach with taxation. Right hand side, P limited, Q limited. P is a levered firm, Q is an unlevered firm. Please practice in writing. More practice in writing, more comfort you will get, more confidence you will get. You will be able to present in the exam also. Reading the answer is not enough. Practicing the answer is required. And you have to practice only. Full answer you have to practice. So first you write down EBIT. EBIT is 20% into 30 lakhs. Is it 6 lakh? 6 lakh. What is my next point? I will deduct interest. To get the value of the firm, I will have to find value of equity plus value of debt. Is it right? Which firm will pay interest? P. How much? 10% of 18 lakhs is 1 lakh 80,000. Point C, EBT A minus B 4,20,000 and 6 lakh. Correct? So what you have to do, the only thing you have to do now, if you have taxation, then under net income approach, you have to first deduct tax also, less tax at the rate of 50%, 2,10,000, 3 lakh. Point E, write down, earning after tax is right. How much? Same, 2,10,000, 3 lakh. So point number F will be cost of equity 15%. 15%. Why we have taken 15% in both? So you are aware that under net income approach, K is constant. K is constant. I have given you a chart today where you can see under net income approach, which approach? Net income. K is constant. If K is constant, it means it is 15% for both. Right. Point number next. Value of equity. E divided by F. 2,10,000 divided by 15% is 14 lakh. 3 lakh divided by 15% is 20 lakh. Next point is add value of debt. Here it is 18 lakh, first column, second 0. There is no debt. Therefore, value of firm G plus H 32 lakh, and so this is your first answer. You will get 2 or 3 marks for this much effort. Now suppose if there is no taxation, what we do? For same question, if there is no taxation, this line you will remove, this line you will remove. Okay, if there is no tax, don't do anything. Without taxation, EBT divided by K, value of equity plus value of debt is value of firm, net income approach. And with taxation, deduct tax, get EAT, then value of equity. So there is no major difference between the approach of solving. Now, answer is not over. Second part of the question is find the value of the two firms using net operating income approach. Under net operating income approach, always first calculate the value of unlevered firm. Value of levered firm is more than value of unlevered firm. To to the extent of present value of tax shield. Okay, so write down point 2. You have to practice so many approaches, so many situation. Value of two firms under NOI approach bracket with tax. The chart that I had given you was without tax. Is it right? But if there is taxation, then what we do? We solve in 2 steps. Step 1, value of unlevered firm we will calculate first. Which is the unlevered firm in this example? Q. So write down value of Q limited is EBIT upon KO. EBIT 6 lakh is right. And how much is KO in the problem? 15%. It is written here on the screen. On the screen, capitalization rate of 15% from an all equity company. So this is KO of an unlevered firm. 15%. So tell me 6 lakh just wait a minute, because there is taxation, it is 1 minus T also. Yes, 1 minus T. There is taxation also. Is it 20 lakh? EBIT into 1 minus T if there is taxation. If there is no taxation, EBIT by KO. Okay. Are you getting 20 lakh?
Yes, sir.
Step 2. Step 2 will be value of levered firm. Which is the levered firm? P Limited. Is it right? So, do you remember the formula for levered firm when there is taxation is equal to value of unlevered firm. Value of unlevered firm, but value of a levered firm is more than unlevered firm to the extent of present value of tax shield on interest, which is equal to debt into tax rate. This debt into tax rate is the present value of tax shield on interest that I have given you today in the summary. So value of the unlevered firm already calculated above 20 lakh. Same figure. This figure you have to copy here. What is the debt? 18 lakh. And what is the tax rate? 50%. So the answer will be rupees 29 lakh. The answer is rupees 29 lakh. Do you agree? Say yes. We agree. This is 6-mark question. Only this much effort you have to take. Okay, now we'll take one more important question. 31. Another variety of question. So today is variety. Are you ready?
Yes, sir.
Question number 31. A and B are identical in every respect except capital structure. A Limited does not employ debt in the capital structure, whereas B Limited employs 12% debenture amounting to rupees 100 lakh. So tell me, which is the levered firm in this example? B Limited is levered firm. Which is unlevered firm? A Limited. Wonderful. Assuming all assumptions of M&M model are met. Tax rate is also given, so we have to solve the problem with taxation like the one we did previously. 30%. EBIT is rupees 25 lakh. Equity capitalization rate of A Limited is 20%, and A Limited is an unlevered firm. A Limited is an unlevered firm. So this is the question of M&M approach with taxation. So first we will value A Limited, then we'll value B Limited, which is an unlevered firm, by applying the same formula. Which formula? This formula on the screen. Value of a levered firm is equal to value of unlevered firm plus debt into tax rate. After that, what they have asked, calculate the value of both the companies and also find out the weighted average cost of capital for both the companies. October 19 MTP 5 marks, April 21 MTP 5 marks. Which company we should value first? Unlevered firm, right? Which is unlevered firm? A Limited. So first write down calculation of value of unlevered firm A Limited under M&M approach. Under M&M approach. So what is given? Cost of equity is given 20%. KO will also be equal to 20%. Why? Since it is unlevered firm. No debt. If there is no debt, then KO is equal to KE. Okay. Then write down value of firm or value of equity, because both have same KE and KO. So value of firm and value of equity both will be same. Is it right? So you write down EBIT if there is taxation into 1 minus T upon KO. If there is taxation, then you have to multiply by 1 minus T. EBIT, just check, is it given in the problem? 25 lakh. Into tax rate, is it given in the question?
Yes, sir.
30%? 30%. And KO we have written above 20%. So would you be kind enough to reply 25 lakh into 0.7, 87 lakh 50,000 is the value of equity or value of firm A Limited? Both are equal. Both are equal because there is no debt. There is no debt. Whatever is the value of equity is the value of the firm. So this we'll be using in the next answer now, 87 lakh 50,000. Next heading, write down point number 2, value of levered firm B Limited as per M&M approach. As per M&M approach. Okay. So write down is equal to value of unlevered firm plus, come on, debt into tax rate. 87 lakh 50,000 plus how much is the debt in case of this firm? You can see 100 lakh there. And how much is the tax rate? 30%. So that comes to 1 crore 17 lakh 50,000. Then they have asked you one more question. Weighted average cost of capital for both the companies. For A Limited, we have already answered 20%. 20% is the WACC for A. For B, write down WACC for B Limited will be EBIT into 1 minus T upon value of firm. Is right? So EBIT was how much? 25 lakh. Write down into 1 minus 0.3. Value of firm we have got just now, 1 crore 17 lakh 50,000 into 100. Yes. $14.9. 14.9%. 14.9%. They have not asked you, but if they ask you value of equity, then what will you do? This is extra. Value of firm minus value of debt. So 1 crore 17 lakh 50,000 and debt is how much? 100 lakh. So this will be 17 lakh. This way you can find the value of equity. Is right. So sometimes they ask you value of equity also. So you can do it like this. Question number 24. Please come to question number 24. November 18 RTB and May 2020 exam for 5 marks. Oh my God, 5 marks. Either MTP or exam. Ronak Limited is an all equity finance company with a market value of rupees 25 lakh and the cost of equity is 21%. So all equity finance company means unlevered company. Market value of firm means market value of equity also. And cost of equity means overall cost of capital also. So KO and KE are 21%. Value of equity and value of firm both are 25 lakh. Company wants to buy back equity shares worth rupees 5 lakh by issuing and raising 15% perpetual debt of the same amount. So what they want to do? They want to reduce equity and in place of that they want to use debt which will carry interest at the rate of 15%. Rate of tax may be taken as 30%. After the capital restructuring means after equity is reduced and debt of rupees 5 lakh is introduced and applying model with taxation, you are required to compute market value of J, cost of equity and WACC using market value weights and comment on it. Similar to previous question, First, what I'll do, first we will find out the value of Ronak Limited when it was an unlevered firm. Now it has become a levered firm. So when you become a levered firm, the value will go up. How much it will go up? To the extent of present value of taxable on interest. And the present value of taxable on interest is debt multiplied by tax rate. So once you do it, you will get the value of this company. From that you deduct value of debt, you will get market value of equity. Yes or no? Market value of the firm minus debt is market value of equity. Cost of equity will be earning after tax upon market value of equity. And weighted average cost of capital, just now we have done EBIT into 1 minus T upon value of the firm. All basic formulae they are testing. Is it right? I have seen in my experience very few students are able to solve such questions. You may find it repeated, boring, but in the exam hall, very few students are able to exactly understand what I have to do, which formula to be used. So when they are saying M&A approach with tax, first thing unlevered firm value, second thing levered firm value, minus that value of equity. EAT upon value of equity is cost of equity. EBIT into 1 minus T upon value of the firm is overall cost of capital of the firm. So let us practice one more time. So write down calculation of value of Ronak Limited. Calculation of value of Ronak Limited. Keep writing. First point, value of Ronak when it was unlevered firm. When it was unlevered firm. So value of the firm is equal to EBIT into 1 minus T upon KO. So value of the firm is given to you 25 lakh. So we can find actually EBIT in this process. EBIT is missing. What is the tax rate in this question? 0.3. This time reverse question. KO is given 21%. 0.21. 0.21. So EBIT is 7,50,000. We'll just make a small change in heading. Calculation of EBIT, instead of value, write on EBIT of Ronak Limited. Calculation of EBIT of Ronak Limited when it was unlevered firm. Because value of firm is given. Okay. Now write on to value of Ronak Limited after restructuring. After restructuring means on becoming levered firm. On becoming levered firm. So value of levered firm is equal to value of unlevered firm plus in bracket debt into tax rate. Debt into tax rate. So that value of unlevered firm 25 lakh is already given in question. Debt will be 5 lakh after restructuring and the tax rate is 30%. So the final answer would be 26 lakh 50,000. Is it right? So my first question was what will be the value of J Limited after restructuring? This is 26 lakh 50,000. Okay. Now the next question is what will be the cost of equity? So for that first I will find out value of equity. Value of equity formula is value of firm minus value of debt. So you will say value of firm is 26 lakh 50,000 minus 5 lakh is 21 lakh 50,000. Follow the process. Okay. So now tell me, in order to get cost of equity, what will I do? What do I need?
Cost of equity and value of equity.
Cost of equity I have to find. So I need earning after tax upon value of equity. And to reach earning after tax, I have already calculated EBIT. Okay. So step number 3 write down, which is your question number Roman 2. Calculation of cost of equity. See, with practice you will understand. Okay, I can understand that it may be confusing, but with practice you will be able to get the answer. Otherwise this chapter many students leave, many teachers also leave. Okay, they also get confused, but there is nothing to be getting confused. If there is taxation, follow the principle. First find a levered firm, then find levered firm, then find value of equity, then find cost of equity, which will be earning after tax divided by value of equity. EBIT. How much is EBIT? 7,50,000. Point B, less interest.
So interest is 1 lakh.
5 lakh is the debt and rate is how much? 15%. So you should write calculation also, because later on should not be confusion. So you get EBT 6,75,000. Point D, less tax at the rate of 30%. Tax at the rate of 30%. So how much is the taxation? 30% is 2,02,500. So you will get earning after tax. This is the earning available to equity shareholder, 472,500. Do you agree? This is the income and this is the value. So don't you think that if this is the income and this is the value, I can get KE now? So point number F, write down value of equity. Go to previous step. Step 2. 21 lakh 50,000. So therefore, cost of equity E by F 21.98% approx, write down if you are rounding off. And this was your second question. Third question, WACC. So right. Next step 4, WACC is EBIT into 1 minus T upon value of firm. upon value of firm. Numerator and denominator should be consistent. When you are computing cost of equity, we take earning after tax upon value of equity. When you are computing for the entire firm, WACC, EBIT into 1 minus T upon value of the firm. Okay, right. What is EBIT? 7,50,000. What is tax? 30%. And value of the firm you have computed here, 26,50,000. Can you see this? 26,50,000. So multiply by 100 once you get the answer.
19.81%.
Around 19.8% right on approximately. This is a shortcut way. Otherwise you can prepare a table, source, amount, weight, cost, weight into cost. You can see in the study material, institute have prepared a table to reach that answer. The final answer is 19.8%. Okay. So there is one more line in the question. What is that one more line? Comment on it. So what is the effect of this restructuring? Write down comment. Comment, write down. So what is your comment? What happened to KE? KE, which was 21%, has become 21.98%. But what happened to KO? KO, which was also 21%, has reduced to 19.8% because of use of debt, which is cheaper than equity. Okay, so write down cost of equity has increased from 21% to 21.98%. And second comment, write down KO has decreased from 21% to 19.8% due to use of cheaper debt. Debt is cheaper than equity because debt was available at 15% rate of interest. So if you increase proportion of debt, average will fall. Average will fall. Okay. Any query on any question we have done today? No. Okay. So come to question number 17. So first we'll take a small break.